Support, hasn't it, for the Chinese government, which is proving to be quite difficult to read at the moment.
Yeah, he says he's quite happy with some of the support. We'll get more into this HSBC conversation shortly, but happy with some of the support they're getting in the short term. There are the bigger sort of structural questions that some investors are still asking themselves about banks and their exposure to China, so we certainly keep that in mind. European equity markets then about to open up for this Wednesday morning, not expected to go all that far at a sort of overall index level as we wait for the Nvidia earnings later on today. We've talked about those a lot, and we will continue to do so with no apology, because it is going to be one of the big events of the day. In terms of where we go at the start of trade then, the FTSE 100 down 0.1% at the start of the trading day. And actually the futures picture had been suggesting we might see some weakness coming through, particularly in London. And you wonder if that's going to be the HSBC effect. We are seeing that share price open, and it is weaker. That's no surprise, though, given that we saw that weaker in Hong Kong
Glencore's
as well.
down pretty hard. Glencore's down by kind of 3% at the moment. So in terms of the weight, where the money's kind of flowing, it's HSBC soft. Nova's actually soft as well. So you've got some of the drug makers coming off a little bit today. So that's where some of the weight's coming out of the market. So Astra's soft as well. That's going to be a big factor into the London market. But with HSBC, Glencore, and AstraZeneca all soft, London looks like it's probably going to underperform. We're down by 0.4%.
Yeah, HSBC down by more in London than it is in Hong Kong. And if you break it down by sector in the Stock 600, chemicals top of the basket, 2.5% up. Bottom of the basket, though, energy down over 1% this morning.
Yeah, I can see healthcare and banks sort of competing with each other to sort of get to the bottom of that list. It is volatile at this stage, of course, just a minute into trading. But we do have weakness in those sectors that you've mentioned, Guy, then, and banks in particular, and HSBC is such a heavy weight that it is very difficult for London to make gains with that in mind. Thinking about some of the other stock movers and where we are there, JDE Peet's caught my eye. This is a Dutch business. Let's talk about coffee. Good time to talk about coffee at 8 in the morning, I think. And this is a business that has some of the same issues, according to some analysts at least, some of the same issues that we've seen other fast-moving consumer goods companies face, but then with its own issues as well around Russia and uncertainty around Russia. But some of the analysts talking about profit erosion at JDE Peet, and this stock certainly under pressure. We'd seen it under pressure I'm not sure it's open just yet, but we're waiting for it to open, I think. It's down by 5%. Yes, it is negative this morning.
Do you want to talk about Dark Trace? Dark Trace is down by 6%.
Right.
That's the Palo Alto read across.
Yeah.
So you're going to see much more of that across Europe this morning. That's going to be the tech read. So Dark Trace down by 7% now. I wonder how much is going to come out of that space today after that big move yesterday in Palo Alto, which I think we're still trying to figure out. But there's a definite read across into what is happening here in Europe. So it looks like London is underperforming. You can understand why. We've kind of discussed that. Everything else looks fairly flat. I think you're going to see that for the rest of the day. I think this is a market that's going to struggle with direction until we get to that big event. And I know Mark was talking about you're not going to see these big events don't generate volatility. Implied volatility I would agree with, but look in the options market, you can see some significant volatility a little bit later on.
It's interesting how he was definitely putting a sort of macro spin on this and a link to the Fed from Nvidia earnings, which really tells you the significance that this company has.
Yeah, Cameron Crice has been writing about this, that actually Nvidia could be more macro than the Fed even, perhaps. And could we have more of an impact from the Nvidia earnings than the Fed minutes later?
I don't know. It depends what the Fed minutes say, to be honest. So we'll see exactly what comes out of that. But I find it extraordinary. Does it feel like a different time to you? We're talking about NVIDIA and the potential move here, and it just reminds me of 1999. It just reminds me. Bubbles are formed at the top. I was discussing this with Dan Curtis a little bit. Bubbles form right at the top. You got an options market that is implying potentially a doubling of the stock by Friday. I know this is a big out of the money call, but that's where the open interest is.
Right, that's the interesting story coming out of the options market. Interesting. A little bit later on this hour, in fact, we'll have a conversation with a credit analyst who is going back to the dot-com bubble and thinking about how long it takes stock markets to recover from bubbles, to build them up, and then to crash and then to build back. And she's drawing contrast with credit markets, talking about corporate credit in a different context. So interesting to make those parallels. Let's dive a little deeper into the HSBC story, shall we? One of the surprises coming out of this number is a charge that the business has taken with in relation to its Chinese business, the fourth quarter charge around BOCOM investment. Let's listen to the way that the HSBC CEO Noel Quinn described this earlier on.
In the fourth quarter, we did have some noise in the numbers. We have had an investment in BOCOM for 20 years. Every quarter, we have to do a valuation in use test. We did that again this quarter, updated the model, and it compares the value in use to the carrying value, and the value in use dropped below, and that resulted in a 3 billion charge. And I just want to make clear that has no impact on our capital position of any significance. It does not prohibit distribution because it's non-capital impactful. It is a technical accounting issue. And I also want to reiterate, we have strong confidence in the China economy. We believe there are huge opportunities ahead, and we believe that our partnership with BOCOM has been a good partnership for 20 years, and that status has not changed.
Let's get more on this story. Bloomberg's Will Shaw joins us. Will, give us your take on Quinn's key messages there. Certainly trying to downplay any overemphasis on the BOCOM numbers and the charge there, talking about it being the difference between value in use and carrying value, treating it quite technically. What was the key message that you focused in on?
Yeah, so you heard him there, like you say, emphasising the positive very much, trying to keep the attention onto the big picture rather than the disappointing Q4 earnings results. He talks about those as noise, which are neutral as to the performance of the full year by the bank. He focuses in particular on the 61-cent dividend, which he told us is the highest since the financial crisis in 2008, which came in, that was last year. He's confident in the Chinese economy. He thinks the Chinese real estate market may have bottomed. And the bank also, in the earnings itself, talked about the de-risking of the US and the UK commercial real estate market. Flipping things forward a bit, he's talking about how the bank would like to see more bolt-ons, potentially in wealth management. So you can see he's trying to put a spin on it there a bit, keep looking forward, keep focusing on what's going to happen next rather than Q4.
And good morning, Will. What are the bank's plans moving forward? Of course, we heard from Barclays yesterday, so much emphasis on the strategy. What are the details on potential divestments of business units, acquisitions?
Yeah, they don't have a big plan to rival Barclays and boost the share price, unfortunately. But HSBC, they've been talking about plans for further share buyback, $2 billion worth of stock. And they've indicated that they want to keep a tight grip on costs, which could rise by about 5% during the year ahead.
Well, I'm looking at this. I'm looking at a decent set of numbers. I'm looking at the BOCOM impairment, which has caught everybody by surprise. Investors seem to be focusing on the latter rather than the former, given the fact that the stock is down. Is that the right read of the situation?
I think there's only so much gloss that Noel Quinn can put on the situation today. It was the Q4 numbers everybody was waiting for. They're now here. We know Q4 profits were down a whopping 80%. Obviously, like you say, everybody is focused on that $3 billion charge in relation to BOCOM, the Chinese bank. I mean, Noel Quinn is quick to paint that as a technical issue, an accounting issue. Fair enough, but it was unexpected. Investors woke up very early this morning to have to digest that news. There's very little positive spin that you can put on that in the moment. So Noel Quinn obviously will be hoping that the narrative moves on, that people don't focus on that for too much longer, think about what comes next instead of a bit of a horror show for the Q4 earnings.
Well, great stuff. Thanks for catching us up. Really appreciate it. HSBC a little softer this morning on the back of that surprise. Bloomberg's Will Shaw. Let's take a quick look at what the miners are doing this morning. Glencore's soft. It's down by 4%. Rio's down by 1.4% at the moment. Interesting, Antofagasta and Anglo are both positive on the day. You do have iron ore coming down fairly sharply after the big move that we've seen yesterday. Interesting to see aluminium spiking on the back of a potential risk story surrounding Russian sanctions. Further Russian sanctions announced by the US Friday. We'll look forward to that. Martin Ritchie joins us now to walk us through the story we've had out of the numbers today. Martin, I look at the miners. What am I focusing on here? Am I focusing on their numbers, or am I focusing on the bigger picture of iron ore coming softer, China concerns surrounding what is going on there with the economy? Is this a macro story, or is this a bottom-up single stock story?
This is more of a macro story, really. It has been a huge week for the mining earnings, as you say. Rio Tinto, BHP, Glencore, all reporting lower profits. And I think to understand this, you have to go back to 2022, because that was a huge year for commodities prices, for energy prices across the board. So it's really expected that, that prices having come down last year, they're going to be reporting lower earnings. Also, they've been hit by cost inflation as well over the past years. Those higher energy prices have been a problem for miners across the board, across the world. The slowdown in China, yes, we haven't seen the sort of economic comeback that everyone is expecting. But it has been actually relatively benign from the miners' point of view in China. I've seen copper demand fairly strong, aluminum demand fairly strong, and iron ore actually holding up reasonably well. But I think the issue is there's still a lot of risks to the downside this year, and I think the commentary from the companies this week has been fairly cautious across the board. We had Rio Tinto's chairman today saying the geopolitical landscape has been more complex and the economic backdrop remains very challenging.
And Martin, what do we learn about nickel from these results? Because, of course, it was a huge theme in the BHP numbers. Glencore also very exposed to nickel.
Yeah, that's right. Nickel's been one of the poorest performing commodities in the past year because of this flood of new supply from Indonesia that's really hammered prices. And that's really affected BHP with a $2.5 billion write-down on its nickel assets that hurt its net income yesterday. And in Glencore's results today, Glencore also a big player in the nickel market. Having said that, these companies, a lot of other commodities are very important for them, particularly for BHP and Glencore, and we've seen prices come down there too.
Thinking about the resilience to the China story, Martin, and I hear what you're saying about the longer-term story there, but just sort of in the market at the moment, iron ore having a really tough week, down quite substantially. Is that China-related, and is this something we're going to be watching for next time around, next time we hear from these businesses?
Yeah, I mean, as I said, iron ore has been a relatively positive contributor for these companies over the past year, particularly, say, Rio Tinto. Today, you've seen iron ore earnings rise as their copper business and their aluminum unit actually suffer weaker performance. Prices of iron ore have come down so far this year, but they're still at relatively elevated levels. And, there's a chance that come the big political gatherings in Beijing, which are due next month, there may be more sort of decisive measures by Beijing to stimulate the economy, and that could easily sort of get iron ore moving back up again.
All right, well, you're looking at the iron ore price down 1.3% there. Bloomberg's Martin Ritchie, we thank you. We're going to continue the conversation about commodities with Rio Tinto's CEO. That's just after 10 a.m. UK time. And tomorrow you can catch interviews with the CEOs of Fortescue and Anglo American as well. But let's get a check of some of the individual stocks that are on the move at the open with Joe Easton. Joe.
So here's a couple of those stocks that you were running through with the reporters there. Take a look at HSBC, though, extending those declines, now down 6.1%. That would be the biggest drop since October 2022, if that move holds. And Glencore as well, some of the weakness you were going through there, that one down almost 4%. Rio actually holding up pretty well, down 0.7% at the moment. The dividend looking pretty strong on that one. But have a look at BAE Systems, the UK defence supplier. It's had a huge rally over the past couple of years, given the increased defence budgets. All of the headlines look pretty strong. The dividend, the orders, everything looked good to me. But coming down, giving up some of those big gains this morning following their earnings report today. Then we'll flip over and have a look at a couple of the other ones that we had in stocks to watch. JDE Peet's, now this one a decliner. It's coffee, as you mentioned in the build-up earlier. The owner of the Costco brand, I believe it is, one of their brands over there. That one is actually declining 4%. Weakness in that one. Sales of that one coming down quite sharply today. Carrefour holding up at the moment, 3% gain for them. A lot of discounting in that stock. I saw a lot of negativity in the analyst notes for that one this morning, but that one not looking too bad today. Wolters Kluwer, this is enterprise software, does tax software for companies. A warning out of them based in Amsterdam, weakening on the Amsterdam exchange today. That one slipping about 2%. And we've got a second merger in the UK commercial real estate space in warehouses. We had one just a week ago, and we are seeing Aberdeen Property Income getting a takeover bid today, and that one rising 4%, potentially a bit of the relief in the real estate space for those shares this morning. Then I'm going to have a look at the US read acrosses. We've seen a number of stocks. You mentioned Palo Alto earlier, and we're seeing Darktrace. That's the worst performer in the UK today, down 7%. Palo Alto slumped 20% following their earnings miss last night. And a couple of chemical stocks as well, seeing a read across. International Flavors and Fragrances, a warning out of them from the US. Weakness in some of their end markets, weighing on Givaudan and also Simreeza as well, a couple of those stocks. And finally, SMA Solar in the solar space, a warning out of a big firm in the US in terms of renewable energy, hitting a number of stocks. So there is a read across a few of those sectors this morning. Then just one morning call to bring you. I'm going to bring up Currys because this one stood out to me because HSBC upgrades Currys. Now, the price target is what I'm noticing here because it's 78 pence. Bear in mind the takeover bid for Currys was at 62. So HSBC seem to think that people should be holding out for a bigger bid on that one. And Currys today rising 1% on the London market.
Joe, thanks very much. Joe Easton joining us there from our equities team with a look at some of the stocks on the move. He's talking about upgrades to Currys, that much talked about this week. I think there were others of those.
I find that amazing. Basically, the analyst community is struggling to price this stuff. Private equity is not struggling.
The London market is struggling to price it.
Precisely so.
Yeah.
So HSBC comes out after a bid. Somebody else comes in and goes, we think this is worth significantly more money.
I suppose things are worth what people are prepared to pay for them.
They are, but the analysts, but the analysts clearly haven't said this is a business that we think is worth significantly more. Massive buy rating. You should buy this stock. There's a 30% premium coming through.
There's a lot more to learn here, isn't there, about where it is that these PE companies see value and why London undervalues.
Well, speaking of being unprepared, BAE Systems dipping there, but look at it. It's at a record high yesterday, doubled over the past 2 years. I think what that shows is that investors aren't ready for a Trump presidency because they just aren't braced for the end to the war in Ukraine if he gets in and he stops the funding.
Yeah, there's a lot of dots to join there, for sure. Really interesting. You made the point earlier about Darktrace, and Joe was just checking in on the Darktrace share price, which is weaker in London. There are days where transatlantic read across means nothing, and then there are days where there's plenty of it, and it definitely did translate.
Today feels like it's going to be one of those days.
Yes,
tomorrow feels like it's going to be one of those days as well.
That's for sure. That's for sure. Right, that's some of the early movers on the markets, on the equity markets here wrapped up. We will get a take on risk appetite in the markets coming up shortly. More coming up here on Bloomberg. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Markets today. We are 20 minutes into the European cash trading day, and you've got the stock 600 lower 0.3%. Now, the CEO of asset manager Brookfield says there are opportunities in commercial real estate on both sides of the Atlantic, and he spoke exclusively with Bloomberg's Francine Lacroix.
The biggest, most liquid markets are in the United States. That doesn't mean, therefore, because they're the most liquid, you always find the most opportunities. But Europe, there's less capital, and therefore there will be opportunities here as well.
Brookfield there. Joining us now, Tatiana Grell-Castro, co-head of public markets at Muzinich & Co. Tatiana, really nice to speak to you. Lots to talk about when it comes to corporate credit and bond markets more generally. I want to start, though, referencing the comments we just got there from Brookfield around commercial real estate, how that filters into your world, because we've been asking lots of bank executives this quarter, how much exposure do you have to commercial real estate? They maybe feel under pressure to get some of that off their balance sheet. And where's it going? Well, some of it into your world. So how do you look at the commercial real estate story at this point?
So what we see, as you know, there is the Deutsche Pfandbrief, and there is a few exceptions, but generally what we have seen over the last 10 years or so, pretty much, I think, driven also partly from the financial crisis still, is that the banks got rid of their real estate exposure to a large extent. So it's definitely not an outsized position on banks' balance sheets, and quite a lot of the funding actually, and also as there was more financial engineering, went into the public bond market. And so we have seen a growth in real estate debt in the public bond market over the last 10 years or so. Then in 2022, clearly with higher interest rates, because the funding model was based on low interest rates. And then as interest rates clearly went up and the funding became more expensive, a lot of the real estate sector came under pressure. We then actually looked at it. Luckily, we have a very good sort of analyst pool that can look at it. And there are, I completely agree with Brookfield, there are very good investment opportunities, but you really need to know what you are owning. So it depends clearly on governance, and that is one big issue. But then also, what real estate do you own?
Yes.
And then especially in the US also with commercial real estate, right? It depends on the pocket.
Getting right down to the details matters. We spoke to a number of CEOs last week from the banking sector who were saying we've learned our lessons from the financial crisis, to your point, Tatiana. So maybe we look for some of the risk there in commercial real estate within other markets away from the banking sector. Talking about other risks, equities overvalued, some say, in bubble territory, some would argue. That's not your world, but you link it to your world by thinking about where bubbles are. Do you see bubbles in your universe, Tatiana? What are you looking at?
We don't see bubble territory yet. So the way we look at it is, a year ago when spreads were really wide, everybody said, oh, this is risky, right? When spreads are wide, people say this is an indication of being risky, and then they don't want to own it. Everybody was underweight credit because they were concerned. Now spreads are tighter, and everybody says, oh, is this now overvalued? So we look at credit completely differently. You get your return by being invested. So it's the coupon that makes the return. So when we look at, for instance, a 20-year period, we would have a decline in price, yes, because there will be some defaults, but there's only a 35% decline, but the return via coupon in high yield is over 1,000%. So that 35% really doesn't feature in your return. It is the coupon. So this credit is not something where you time it. And we can see that now, and a lot of money is coming into credit because of the rally at the end of last year. Once it starts to rally, it goes so quickly, you just won't be ready for it. And you don't need to time it because it's not a price return, it's a coupon return.
But is market pricing for rate cuts too aggressive? And do you have to kind of wait for central banks to pivot to see the cash on the sidelines get into the market?
No, we don't see it. So we definitely see money markets, losing funds, and some of it is definitely going into credit. For us in credit, what we need is more stability in interest rates. And clearly, a lot of the interest rate cuts have now been priced out. We felt at the end of last year that was too much. There was too much anticipation of rate cuts, and we are not there that quickly. But where we are now with the 3-4 cuts, that's probably about right.
Can I get back to the defaults? Defaults are really low, hence spreads are tighter and maybe can get tighter. I'm wondering why they're low. Are we seeing some of the bigger risks ending up in the private markets? And is that ultimately where the risk is gonna lie here? The loan market's been really busy. You see everybody ramping up in the loan market. I'm just kind of wondering if we're seeing a risk shift out of public into private, and when are we going to know about that?
There has definitely been a shift, and the deals on the private side are getting bigger and bigger, and the bond market is seen as maybe a little bit too restrictive in what especially private equity wants to do. So yes, the quality of the credit market, especially on the high yield side, has significantly improved over the last few years. It used to be a single B market. It's now predominantly a double B market, especially in Europe, and about half in the US. And then the other thing I think we can't forget is the funding costs, before interest rates went higher, in high yield was around 3%, let's say, roughly. Then it went up to high 9s, and that became too expensive because a lot of the high yield companies don't have the cash flow to fund themselves at such high interest rates. But now they have come back down to around 6, maybe even lower. So we have now actually, because, interest rates have come back from their peak, spreads are much, much tighter. So actually the funding cost is at an affordable level for most companies. And therefore, when you look at how do you go into default, you run out of liquidity and you can't refinance.
Yep.
Refinancing is open again. And liquidity, actually the earnings look pretty decent and continue to look decent. And if we see a soft landing, we don't have to worry about, weak earnings and a weaker and higher.
And you're picking up really decent yield if you're in the high yield markets, by definition. Tatiana, really nice to see you. Thank you very much. Tatiana Grill joining us from Musinish. Tatiana Grill Castro, I want to get that one right. We're going to go back to it next. We're going to talk more about what's happening with NVIDIA. It's a big day for NVIDIA, big day for the market. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. we'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
This is Markets Today. We're 30 minutes into your European trading day. Let's have a quick look at where we are across these markets. And a quick look at the sectors on the downside explains why London is underperforming. The FTSE 100 is down by 0.7% this morning. Overall, we see the Stock 600 is down by just 0.3% because we're pretty flat in Paris and in Frankfurt. But the biggest weights, the heaviest weights on the Stock 600 come from basic resources and they come from banks. HSBC, of course, dominating the banking story. We saw that weaker in Hong Kong, and it's weaker here in London. And then Glencore and Rio Tinto, both of those weaker here in London as a result of those numbers coming through. More normalization seems to be the way to phrase some of what we're seeing from the mining sector after an abnormal 2022.
Yeah, I think costs are really high still, and I think that's really interesting. You listen to what Rio was saying. They're talking about above average inflation still for a lot of their projects. And that's in the US, it's in Australia, it's elsewhere. So the cost story is still something that I think is present and continues out of 2022 into 2023.
Yeah, just managing to eke out gains this morning. You've got autos and parts, consumer products and services, food, beverages and tobacco, but most of the sectors are in negative territory this morning, about 3/4 of them this morning.
Interesting that HSBC is down 7% today in London, which is a big move, even in the context of the Hong Kong share price move.
More
which
so
was,
than that,
Don't surprise the market. Don't surprise the market. If you surprise the market, you're going to get a negative
reaction. And Barclays
reaction.
still gaining. I mean, Barclays a fraction of the market cap, but Barclays is still gaining up by 2.7% on the back of those numbers from yesterday.
But all of those earnings are going to be paled in by comparison with NVIDIA. That's in focus as the chip maker is at the heart of the AI boom. Reports earnings later today. The shares sank more than 4% yesterday in the run-up. And we can get more on NVIDIA now with Lion Trust Fund Manager Claire Playdell-Bouverie. Claire, it's great to have you on for the first time on Bloomberg TV. Thank you for joining us. I understand Lion Trust owns NVIDIA. So why are you so behind it? We get its earnings later. Are we in a bubble?
Morning, it's great to be here. I mean, NVIDIA's Hopper computing architecture has driven down the cost of computing by over 90% versus traditional compute. And this is precisely what we look for in our companies to invest. Innovation is all about creating novel ways to drive down prices for consumers, create genuine customer value. And when you do so in such dramatic fashion, as NVIDIA has done, you open up new markets. And this is what we've seen unfold with AI. AI can't be run on traditional compute. It would be prohibitively expensive and power intensive.
Can anyone compete with NVIDIA?
So NVIDIA has got over 90% market share in AI chips, and they're innovating faster than everyone else. So we think that the company's got very strong barriers to competition. 4.8 million developers live within NVIDIA's software ecosystem, CUDA. And so in order to incent these developers to move off their platform and onto a competitor's, you've got to have a superior offering, so significantly lower cost or better performance. And because NVIDIA has stepped up its product innovation velocity, it's now launching 2 major products, 2 big computing platforms per year. It makes it really difficult for competitors to catch up to their 10-year lead.
How do I value NVIDIA? What model do I apply? The FT had a kind of nice line on this, so I'm going to quote from the FT, which I apologize for. But to get to 740, the share price, or I think we're a little softer than that now, it simply requires the company to maintain its monopolist-like operating profit margins of 55% for the next decade, while also growing sales tenfold from 60 billion a year to more than 600 billion a year, which is kind of circa what the whole of the chip industry does right now. How much visibility do we have on this stock? Do we know what it's going to be doing in 10 years' time? Do we know whether or not it's going to be maintaining its margins for the next 10 years? That's the bit that I struggle with. I don't know how you value this business when there's so much blue sky thinking out there on what it could do.
It's the billion-dollar question. And, I mean, how we think about it is, with this AI build-out, which is obviously integral to NVIDIA's valuation and the story from here on out, we're in the first 5 minutes of the match, to use a football analogy. And perhaps the best way to frame this long-term opportunity is to think about a data center today and picture how this has got to evolve in order to accommodate all of the AI-related demand we're seeing across the pipeline. And we believe that GPU penetration in the data center has got to move from 10%, where it is today, to 50% by 2027. So for every data center that's built at the moment, say you put 100 servers in there, only 10 of these are GPU servers. Why has that got to move up to 50? Well, it's because of all the software that's being developed at the moment that needs to be run on accelerated computing, not traditional computing.
Microsoft out yesterday, there's a story out yesterday saying that Microsoft's going to potentially develop a network chip that's going to replace potentially something that NVIDIA does. Do we really think that Apple, which has been really keen on developing its own chips, Microsoft, all of these other tech companies are going to allow NVIDIA to keep charging the prices that it's charging at the moment? Or do you think there is a risk that they end up doing it? These are companies with huge cash flow generation potential. They have lots of money sitting on the sidelines. They are going to invest heavily. Why are we so certain, when history tells us that we shouldn't be, that NVIDIA can maintain its monopoly position?
It won't be a monopoly. There is room for other players to compete. I think it comes back to the fact this total addressable market is so vast. If we believe AMD's numbers, it's 400 billion just for AI accelerators. And so these cloud players, Microsoft, Apple, developing their own chips, this will be for certain use cases, but for the highest performing compute workloads, NVIDIA's do still remain the gold standard, and we don't see that changing based on sort of their product innovation cadence that continues to be churned out from the company.
Claire, where do you see tech spending generally and the AI portion of that? I mentioned this because we've referenced this morning Palo Alto Networks and their earnings report last night, which really disappointed, and they're flagging some fatigue amongst customers to spend. But maybe that's more to do with cyber, maybe that's not generally their tech budget, or maybe it's increasingly because everything in the tech budget must compete with AI, and that's ring-fenced and still going ahead. How do you assess the customers of NVIDIA and their willingness to spend at this point?
So what we heard from a lot of the cloud providers who have reported so far this earnings season is that the really acute phase of optimization that we saw last year, so customers really constraining their IT capex spends, scrutinizing their budgets, and that's coming to an end. And so we do expect spend to increase from here. Within the IT budget, though, we are expecting more of this to be directed towards the AI build-out and perhaps cutting down elsewhere.
So that might be the trade-off. We might see less being spent on other technology, which is an interesting thing to consider. Take us into the NVIDIA numbers today, then. When they break, what somebody with your level of familiarity with the story is going to be looking for. You steer us toward initial demand for the Grace Hopper chips. Now, my understanding, giant-scale AI is what they service. You know, we've gone deep down now into CPUs and GPUs. So, Claire, tell us, what are you going to be watching for? Because this sounds like it's something that's important.
It certainly is important. I mean, just on the numbers, we are expecting an acceleration in fundamentals. We think that NVIDIA can print between 11 and 12 billion in net profit this quarter, which would be a significant step up from the 1.6 billion in the quarter last year. But looking forward to future drivers, we're really, as you mentioned, on the watch out for updates on the launch of the Grace Hopper architecture, because this is the first time that NVIDIA has ventured into CPUs. So Grace Hopper has an ARM CPU attached to an NVIDIA H100 GPU. And based on the commentary that we heard from ARM on their earnings call a couple of weeks ago, we're cautiously optimistic on demand here. It was launched this quarter.
Let's talk about ARM. Let's talk about everybody else. So, got NVIDIA, it's over here. ARM the other day starts talking about AI. ARM's really good at reducing power consumption, all this kind of stuff. Which other company, where's the biggest gap you think that has the greatest upside that the market needs to fill? Is it in NVIDIA, or is it in stocks like ARM, or is it elsewhere? Where am I looking for the market to have undervalued still some of the potential sort of fallout from what NVIDIA is doing and what's happening in AI?
So we view investing in AI through the lens of a four-tiered technology stack. So NVIDIA occupies a prime position in the base layer. This is sort of the hardware. We think actually the greatest potential and underestimated potential really sits in that top layer applications. We're going to see value emerge there later.
Who's in that? Which companies are in that stack?
So, I mean, consumer-facing companies, Airbnb would be a good example of a company sitting in that app. Palantir, all these companies that we interface with as consumers, bringing AI to the masses sit in that layer.
Does the basic AI stuff, does the server stuff, is that commoditized at some point? Is that where you're going to make the money? Or, as you say, is in the value add? I'm kind of wondering whether or not the big companies like AWS and these companies that do a lot of the server stuff at the moment is really where the value lies? Or is that, like it is kind of now in some ways, just commoditized going forward?
I think you will see commoditization in certain layers, probably in the model layer. We do see that possibly already emerging. It'll be a question of whether there'll be winners and losers at so every layer of this tech stack, and it will be those that are either providing lower cost options for their customers or a higher quality to price ratio, which is sort of how we view investing in innovative companies.
Claire, we go in waves of thinking about being excited about the opportunities. The market clearly very excited about AI opportunities and has been focused on NVIDIA in that regard for some time. And then we go through a period of focusing on regulations and where that takes us. As an investor in this stuff, what do you watch for in the regulatory conversation? Or does it tell me something that's not the first thought you have? It's so far off, or it's just so far out of your out of your purview.
No. We obviously do track regulations and are very aware that this is a key risk when it comes to investing in AI. I think there's so much sort of nuance and sort of a grey area here. The regulators aren't quite sure what that they want to see from these AI players, that we don't have a firm idea of how this unfolds. So just continuing to monitor that trend.
Claire, you've got a fabulous note out. You say that they've gone from a mindset of growth at all costs to profitable growth. We all know tech has the best growth, but what's overlooked is that tech companies have the best cash generation. Is that only going to get more pronounced as AI evolves?
I think that is a very likely outcome. We've seen the likes of Meta announce a dividend, Uber buying back shares, that these tech companies for years didn't really make any money, and despite growing like the clappers, and they weren't actually generating cash. And what we saw in 2022 was a necessity to really rationalize cost bases, because this was tech's recession. And what we've seen this year is a continuation of that trend. So it wasn't just 2023 that was the year of efficiency for Silicon Valley. What we're seeing is a continuation, so years of efficiency. And we expect these tech companies with very strong cash generation to increasingly reward their shareholders.
Claire, thanks so much. Thanks for joining us. Claire Pladel-Bouverie joining us there from Line Trust, where she's a fund manager. Really great to get her insights as we work our way up to those NVIDIA numbers coming up later on today. They will certainly be one of the big event of the day. To watch out for in markets coming up, the UK Chancellor gets a boost from the biggest monthly budget surplus on record in January. We'll get the details there next. This is Bring Back.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
For us is, we've seen quite a strong labour market. We've seen quite a strong household real income. It hasn't really come through to consumption. Swat is absolutely right on that point. If you look at recessions going back to the 1970s, this is the weakest by a long way, because the range, I think, for the numbers for those 2 quarter numbers for all the previous recessions was something like 2.5% to 22% in terms of lost negative GDP. So minus 0.5 is a very weak recession.
Bailey on Haldane, basically. That's what you just got there. The governor of the Bank of England, Andrew Bailey, talking about the call from former chief economist at the Bank of England, Andy Haldane, talking about the fact that the bank needs to get on with it, cut rates, or risk a recession that is fairly mild at the moment, as we just heard, getting maybe a little bit worse. Lizzie, this was in response to an interview that you did with Haldane. Haldane has some credibility in as much as he was quite hawkish on the way in, which the bank kind of was but wasn't. But can't you understand why the bank is being as cautious as it is? Does it have a straight line to lower inflation? Haldane's convinced that it does, but does it?
You know the answer to that. Yes, you've got high services inflation, you've got wage growth feeding into that story. That's what Bailey cites in response to the recession fears, Bailey playing down the fears about recession. But it is nonetheless embarrassing, according to Marcus Ashworth, our Bloomberg opinion columnist, that the former chief economist of the Bank of England should be saying this. And look, Haldane was vindicated about inflation, saying, it was the tiger that needed to be tamed on the way in, and look at it now.
Let's broaden the conversation, because this is all the macro, this is all the monetary policy conversation, which is very live and vigorous here in the UK. There's also a fiscal conversation to be had, and we had some data out this morning, a record surplus in a pre-budget boost to Hunt, perhaps. Let's go to our colleague Sophia Horta-Acosta, who joins us now from the Markets Today blog, to give thoughts here, because things can be recordy, Sophia, when you're in a more than average inflation environment, can't they? And I wonder whether that has anything to do with it here. What do you make of this data out this morning?
So the 2 R words, right? Record and recession, and how does that play into Jeremy Hunt's March 6th budget? That's what everyone's talking about right now. January was always meant to be a strong budget surplus. I mean, this is a seasonal impact. It's when tax receipts come in, the self-assessment. So this should already be factored in by Jeremy Hunt. And why did we have a record? It was a record in nominal terms, not in percentage terms. But essentially, borrowing is running a lot lower than the OBR forecast. So it's not necessarily that just because of the tax receipts, but also the borrowing is coming down. I would like to point out that as a proportion of GDP, public sector debt is still at the highest since the 1960s. So let's kind of couch this with a little bit it's too early to be celebrating, a victory over this, Lizzie.
Which, of course, is important politically, because it was one of Rishi Sunak's 5 big pledges to bring down debt last year. I also, as we look ahead to Jeremy Hunt's budget on March the 6th, just want to flag a scoop from our colleague Joe Mays. He says that Hunt's weighing plans to spur pension funds to invest in UK assets. Now, we already had a bit of this on the autumn statement, of course, but this is more. It would be that pension funds have to disclose how much they're invested in the UK, and maybe there'd be a threshold. We've got the idea for a British ISA, of course, tax-free investing there. Is it just going to be a bit of a tax sandwich, though, as we have other taxes going on? We have tax measures going on in the budget as well.
Yeah, and I think, you mentioned markets and investing in UK assets, which has been a big push by the UK government. So I just want to focus on that for a moment. Can you really, you can remove all the red tape, you can make it easier for pension funds to invest here, but can you really force them to invest in underperforming assets? And, I think the problem here is that the UK market just isn't moving ahead. And
this is the problem, isn't it? Basically, you're also telling retail investors as well, invest in the UK, which has, as you say, underperformed. Why are they encouraging potential portfolio risk on a population that has already made it very clear that it's not interested?
Yeah, exactly. And these assets they've gone into government bonds. I mean, they've gone into gilts. There's the rotation out of the stock market and into the gilt market for historic yield reasons. But at the moment, there isn't. I mean, we have Nvidia reporting today. I think that really kind of shines a light on the FTSE 100 and its lack of tech. Just 3 stocks today are falling. HSBC, BAE Systems, and Glencore. Those 3 stocks are enough to make the FTSE 100 fall. I mean, it really shows the concentration of relatively unexciting stocks when the rest of the world is looking at the US and looking at tech. The FTSE just doesn't offer that.
And this, if we do hear more about this British ISA, for example, this will be part of a long-running theme from the government trying to get more money to go into UK equities. Meanwhile, we have conversations with executive after executive from journalists across the media and from here at Bloomberg asking them, are you happy with your London listing? And this is a very live subject, isn't it? BAE Systems having to answer questions on that this morning.
And they said they were, which is interesting. It kind of goes against the grain a little bit. There's it's not just a valuation problem being listed in the UK. You have a valuation discount, a pretty steep discount, not just in relation to the US, but also crucially in relation to Europe. And we saw, some companies, TUI, the travel operator, actually choose a Frankfurt listing over a London listing. So it's not just really high valuations in the US that's the problem, but it's also a liquidity issue. When you have a shrinking stock market and you don't have that pension, that pool of capital really kind of coming into the UK market, then your stock just doesn't trade, and then that's a problem for liquidity because funds like liquidity, so they're more likely to invest in a liquid stock.
All right, Sophia Otteray-Costa from our Markets Today blog, and you can get more on the live stories from the Bloomberg Markets Today team by typing TLive Go on the terminal or going to bloomberg.co.uk. Speaking of scoops on the UK, interesting one about the Abu Dhabi Sovereign Wealth Fund, Anna, looking to get a stake in Heathrow. It would mean that you've got lots of Middle Eastern backers of Heathrow. You've got Saudi's PIF and the Qatar Investment Authority already shareholders there. And it's a broader theme, isn't it, in the UK? You've already got the Telegraph newspaper under consideration to have a takeover, but the government intervening in that.
Yeah. Does this take us into a conversation about UK assets up for sale? I mean, it takes us into a conversation about sport as well, because there's plenty of Middle Eastern money in sport.
I can't believe you've gone there, but yes.
I'm looking at you.
With a minute to go.
That's all I had. Bail me out.
It's an infrastructure play, isn't it?
Yeah.
Your play, it's and what is interesting as well, this is going to put my airline hat on, hubs are getting more constant. So point to point is becoming less of a story for the airline industry at the moment, which is the direction we thought we were going to be going in. Big hubs are like New York, like London, like Singapore are becoming more important. So therefore, as an asset, this looks like a much more valuable asset potentially going forward.
Okay, we just need to check on a few movers this morning. HSBC is certainly one of those, and we tracked it in Hong Kong. It was weak in Hong Kong. It's now weak in London as well. You can see it on the move there, down quite substantially in the London session, more than 6% off earlier lows, but it's in decent company with Glencore as well, which is also an area of weakness. The China theme running through both of those, although our colleague who covers the mining stocks was actually downplaying that to some degree, the role of China in the mining sector. We should mention what is coming up today. 3 p.m. UK time, we'll get Euro area consumer confidence data. 6 p.m. London time, we'll get the US Treasury will auction $16 billion worth of 20-year bonds. Later at 7 p.m., we will get the Fed's January minutes. We certainly have spent a bit of time talking about that. We would have spent more time talking about that if we didn't also have NVIDIA earnings. We will certainly be looking for those NVIDIA post fourth quarter results after the US market close, and that will be certainly where Guy's attention is, even that late, possibly.
I may stay up for it. It's that exciting.
It is.
But this will dominate tomorrow morning. This will set the tone tomorrow morning. US markets could be all over the place later on. I'm not saying that volatility, the VIX is going to rise, but this could be one of those events that pull these markets around really quite significantly.
Okay, bit of M&A confirmed this morning then. Saint-Gobain offering to buy Australian rival CSR for $9 Aussie a share. I mentioned this because Bloomberg had a scoop on it earlier on, suggesting that this was in the offing. So some more M&A this morning. That is it for markets today. European stocks then under pressure this morning, certainly on the London market. HSBC and Glencore providing some weakness there, down by 0.7%. Elsewhere, we wait for NVIDIA. US futures point a little lower.
They do. They certainly do. We'll keep an eye on all of that. We'll have some great coverage tomorrow morning. From us, have a great day. Fran is up next. Lizzie, thank you very much indeed. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They made 26 attacks. We've given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to.
Paul from the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Retreating from near the record high. Again, we had some mixed earnings. So if you look at some of the companies that came out today with figures, I'm looking at Glencore dropping after a steep profit slump. I'm also looking at Rio Tinto. This is, of course, the world's biggest iron ore miner. That declined as underlying profit fell on weaker metal prices. But, for example, on the flip side, we have Carrefour gaining after the French company announced a share buyback. We'll also talk about HSBC. It's pretty much flat apart from the FTSE MIB in Italy. That's gaining 0.4%. Also, the French building material company Saint-Gobain says it's in talks to consider an acquisition of its Australian rival, CSR. So it's offered to buy CSR. I think we now just have confirmation from that. It was a Bloomberg scoop earlier for $9 Australian per share in cash. Now, shares in HSBC have plummeted after disappointing earnings. The bank has taken a $3 billion impairment charge relating to its investment in a Chinese bank. Well, earlier we spoke to Chief Executive Noel Quinn, who told me that the charge is a technical accounting issue with no impact on capital.
Well, I'm very pleased with the fact that we've been able to report 30 billion of PBT, which is obviously a record. But also, I'm very pleased with the return on tangible equity. We've been working hard for the past 4 years to make sure we deliver mid-teens returns, and we did that last year. before material notable items, we had a return on tangible equity of 15.6%. I'm also really pleased with the dividends we've announced, 61 cents, which is the highest dividend for the full year since 2008. And we completed $7 billion of buyback. And we announced another $2 billion, up to $2 billion buyback this year. So I'm really pleased with that. Strong capital generation. And I believe with a CET1 ratio of 14.8%, we've got strong potential future capital distribution as well. In the fourth quarter, we did have some noise in the numbers. We had three principal items that pulled down the profit. The first one was we rebooked the loss on sale of our French operation now that we completed that transaction. It's neutral for the year because we took a credit on that in Q1 and we've taken a charge in Q4, so that nets each other out and neutral. There was an adjustment for hyperinflation in Argentina driven by the devaluation that took place. That's really a technical issue. And then the third issue, technical issue, was BOCOM. We have had an investment in BOCOM for 20 years. Every quarter we have to do a valuation in use test. We did that again this quarter, updated the model, and it compares the value in use to the carrying value, and the value in use dropped below, and that resulted in a $3 billion charge. I just want to make clear that has no impact on our capital position of any significance. It does not prohibit distribution because it's non-capital impactful. It is a technical accounting issue. And I also want to reiterate, we have strong confidence in the China economy. We believe there are huge opportunities ahead. And we believe that our partnership with BOCOM has been a good partnership for 20 years, and that status has not changed.
Well, that was the HSBC Chief Executive, of course, Noel Quinn. We spoke earlier, and he was really at pains in explaining that, look, this was an accounting concern, that he was quite proud of the earnings. And then we, of course, also spoke about the share buyback. Now, to talk about HSBC and the banking industry as a whole, we're joined by our Bloomberg opinion columnist, Paul Davies. Paul, thank you for joining us. So HSBC is down. We heard there from the Chief Executive really trying to justify why they had to take their impairment, saying, look, there are challenges ahead for the economy, but the bank is pretty strong. Do you have reservations on or why is the stock down?
So I think the stock is down, like you were saying, because of this surprise charge on BOCOM, and because of the surprise around the effects of Argentina and the devaluation there and the accounting that they have to use that. I think with BOCOM, the interesting thing is that, as he said, it didn't affect capital, and the reason why is because they have a bunch of sort of regulatory restrictions on capital that are related to their kind of investments in other financial groups, which is quite standard for banks. And when they wrote down this stake, when they impaired the value of BOCOM, they were allowed to release some of those restrictions. And what they were just telling investors and analysts on the earnings call before I joined you was there's another sort of $14 billion worth of these kinds of restrictions that can be released against any future write-downs of BOCOM or other financial investments that they have. So I guess they're kind of trying to reassure people there that not only is this one, this particular instance doesn't hurt their ability to pay dividends or do buybacks, but they have this other kind of very large set of capital that they could release against any future charges.
Paul, so in my interview with him, and again, he did say that actually, the bank is very well provisioned on some of the China real estate risk. He also said, look, he doesn't expect a big spillover coming, for example, from the commercial real estate in the U.S. There was not much commitment on how much they would return to shareholders for the whole year. I mean, do banks now just need to give back in terms of, dividend share buybacks, like we've seen it with a number of banks, including UniCredit, for investors to buy into the story?
Yeah, I mean, I think, banks are complicated and difficult things to understand, and investors like to see the money to demonstrate that the bank is doing well and performing well. I mean, I think that HSBC is one of those banks in a very good position. They've still got this Canada sale to go through. They've committed to probably doing a special dividend when that sale goes through and they get the cash from that. And then the analysts at Citigroup, in their note this morning, were saying that even after that special dividend, they'll probably have another $8 billion of capital in excess of what they need. So they've got plenty of money to carry on fulfilling, further buybacks next year. Beyond that, as interest rate incomes starts to decline a little bit or not grow as fast, then there'll be more questions about how much returns they can really make then.
Yeah, Paul, thank you so much. I'm looking forward to reading your column. Paul Davies there from Bloomberg Opinion. We touched on HSBC, but of course, Paul also wrote brilliantly on Barclays and some of the challenges there. Now, to talk more about markets, interest rates, and of course, what kind of environment these banks are operating in, we're joined by Maria Munichi, fund manager at M&G Investment Management. Maria, as always, thank you so much for joining us. I feel like January 2024 is certainly like a tale of two fortunes. If you look at asset classes, they're not really all performing the same way. There's these big days of risks. Like, what will be fundamentally what the market's looking at over the next couple of weeks?
I think it's been very, very interesting to see a start of decorrelation actually across asset classes, so between fixed income and equities in the start of the year, which is something we have not seen for quite a long time. But also when we look within asset classes, within equities, within fixed income, a lot of differentiation of returns if you look at the tech sectors in the US versus Chinese equities, for example. And this is potentially an opportunity for asset allocators to find opportunities in an environment which, to my mind, continue to be pretty unpredictable and very much data dependent. So we have seen low volatility so far in markets this year, but I think there is quite a lot of data coming up that could potentially shift the narratives around what we're seeing. Today, investors are very much focused on not only a soft landing, but very much a no landing. So I believe the growth is quite robust. But I think we have to be conscious about data coming up.
Maria, what's interesting, so I'm subscribed to every single newsletter under the sun and analyst research that I can get my hands on. And this morning it was all like, it's NVIDIA day, it's NVIDIA day. I mean, is this now like almost as important as Jobs Day to try and figure out whether the rally that we've had, certainly for the Magnificent Seven, makes sense?
I think the role of these companies have increased massively when we look at relevance for global markets as a whole, not only for their single performance, but also for some of the sentiments they bring to investors overall, and the willingness to continue to back equities and this growth trend. So absolutely crucial to observe what's going to happen with NVIDIA's results. I think the underpinning fundamentals are very, very strong, especially on a longer term perspective. The stock has run a lot. But valuations on a longer-term basis might not be so extreme. And I will say also that, yes, there is a very important data point today, but also next month there will be a conference around tech users, and that will continue to feed information to markets to make decisions around the stocks as well.
Maria, and you say it so beautifully, this is like, it's almost a sentiment gauge, right? If tech does well or some of these valuations are okay, then the rest of the economy will do fine. But actually, it's a very different, I mean, we need to look at inflation, we need to look at productivity in the US, which is soaring. So is it a little bit of a misnomer, focusing so much on valuation instead of looking at some of the other fundamental, I guess, questions?
Completely. And I think, you are seeing within one economy like a very different piece of the puzzles, and it's very important to keep an eye on all of them. And I think one area that potentially, has gone recently under the radar is the US regional banks, which were very much in focus in March last year. But, when we look at some of the fundamental trends there has been a reduction in lending standards. Those are tighter today. I think at the beginning of the year, we've seen a bit of a normalization, but, the consequences that this can have on, small and medium businesses, it's also something that I think has to be at the core of what investors are looking at today, but also what the central bank will be looking at when making their next decisions around rates.
Maria, thanks so much. Maria Munichi there from M&G Investment stays with us. Coming up, our exclusive conversation with the chief executive of asset management giant Brookfield. Bruce Flatt tells me about plans to invest in financial infrastructure and the future of commercial real estate. That's next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Now, Brookfield Asset Management plans to start a pool that invests in financial infrastructure such as payment systems as demand for the asset class grows. Now, in an exclusive wide-ranging interview, the chief executive of Brookfield, Bruce Flatt, also told me that he believes there are opportunities in commercial real estate. Well, Brookfield is one of the world's largest infrastructure investors.
We own the backbone of the global economy. So we're trying to find good countries, go there and stay there, invest in these things, and whether governments come or go, or interest rates go up a little bit or down a little bit, aren't really relevant to these themes in the long term. You need to make sure you have liquidity, you can fund yourself, and you run good businesses, and that's more important than those general trends. So we're investing for 10, 20, 30, 40, 50 years. And you can't get too caught up in the day-to-day effects.
You've also gone to credit. How much are you expecting that to grow?
Look, what's happened with regulations in the banking system is they've just, it's pushed out credit off the balance sheets of the banks, and the right place where that is being funded from is institutional investors. And therefore, investors like ourselves are continuing to grow our businesses where we're funding these type of products. But it's not, our business is not in competition with the banks. It's actually in partnership with the banks. And as a result of that, I'd say it's facilitating the growth of the global financial markets, as opposed to something that often people talk about it, that we're at the wrong time in the cycle or whatever it is. This is going to be growing and happening for a long period of time.
So how big do you expect?
It's going to get big, because remember, this is where most of the capital is in the world, is in sovereign institutional funds. These and pensions. These funds used to be 20 and 30 billion. Today they're 300 billion, 500 billion, $1 trillion and a half dollars. These are large sums of money. They need to put it to work, and therefore it's going to continue to grow for a long period of time. We have, in our private equity business, we have a buyout sponsor business, but we're also doing, we're just in the midst of creating a strategy for the Middle East, which will be a separate pool of money. We're creating a strategy for financial infrastructure, because we think that's the next phase of infrastructure investing is in the financial backbone of the global economy. And a lot of the world has been pushing towards financial infrastructure, and it's not appropriate for our infrastructure fund. Right. But so we're creating a new pool of money to do that. And so there's a fine line between having too many things and making sure your clients who want to be invested with you in that type of area have a pool to be able to do it with us.
Commercial real estate. So a lot of people say, look, this is not the right time. We're going to see a shakeout in commercial real estate.
there are opportunities that you see?
Yeah, I think, look, the next story is that interest rates are coming down. Fundamentals are pretty good in a lot of commercial real estate. Of course, there's a tail of some investors that had properties that for this environment, the fundamentals either don't support it or the financing they have can't be supported, and therefore those have to get dealt with. So that's a tail that's getting dealt with within the financial system. But fundamentals are actually getting better. Interest rates are coming down, which means the values are going to improve. And but that tail, there's opportunity coming. And if you know what you're doing, you can pick the right assets. There's a great opportunity here. And
so you're buying?
We are buying. Our opportunistic fund, we just bought we foreclosed on some loans for multifamily in the U.S. recently. We're very excited about that. And we continue to look at a bunch of things.
Do you see anything in Europe?
Absolutely. I think there'll be, the biggest, most liquid markets are in the United States. That doesn't mean, therefore, because they're the most liquid, you always find the most opportunities. But Europe, there's less capital, and therefore there will be opportunities here as well.
But how do you make a difference between the ones that will get better and the ones that actually you should forget?
I would just say it depends on the types of real estate. You just need to, quality wins always. It always has. It always will. And therefore, if the great money can be made in buying high quality properties that have financing problems. That's where the easy money is made, and that's the biggest focus of ours.
Well, that was Bruce Flatt, the chief executive of Brookfield, speaking exclusively to us, and then you can catch him on Leaders with Lacroix coming up next month. Coming up, we listen back to Andrew Bailey's latest comments, sending a message on the BOE's rate cut prospects. That's next, and this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The inflation to come back to target before we cut interest rates. I must be very clear on that. That's not necessary. So we'll be looking for sustained progress on those things to reach that judgment about how long this period of restrictive policy needs to be. But we have very clearly signalled this change.
Well, that was Bank of England Governor Andrew Bailey on the UK rate cut debate. We're back with Maria Monicki from M&G Investment Management. It's not easy being Andrew Bailey right now because he has a tougher job than everyone else. Are you invested in UK equities?
I think the UK at large, equities and bonds have seen quite a tough reaction from investor sentiment, and this provides potential for good returns in the future should things normalize. I think in particular in UK gilts, after the recent rally in yields, we're starting to see some more opportunities again. We can see inflation starting to come down and even better than expected. And at the same time, the economy is potentially weaker than in other parts of the world, in particularly relative to the US. So I think the current level of yield is potentially attractive over a longer period of time. Obviously, there might be still some volatility along the way.
I'll say the elections, the budgets.
Absolutely, yes. I think there is very much a lot to look forward within the US, and I think whatever the outcome of the election will be, I think we might see some, volatility within the market before that could provide opportunities. But also, I would say the next government will inherit quite a difficult situation from an economic standpoint. So there will be quite a lot to see in the UK. Going forward, I think.
Maria, do you worry about commercial real estate and impact or infecting other parts of basically our markets?
I think it's an area that was very much in focus a few months back last year, and then is going to be under the radar. I think it remains quite important to keep a keen eye on that. I think the change in interest rate will definitely have an effect on some of the weaker parts of that market, but overall it could also present some opportunity over the longer term because some of the business are equipped to withstand higher interest rates. I think, alongside other long duration assets, like, for example, renewable energy infrastructure, we have seen quite a lot of weakness last year. But when these businesses are well positioned and have good quality, they could actually present today some very interesting longer term opportunities. But we have to observe what the shifts will be. So, for example, from a banking perspective, maybe providing different type of lending at more tighter standards, and then maybe different players coming in to fill these opportunities.
Maria, thank you so much, as always, for joining us today. Maria Monicki, they're fund manager at M&G Investment Management. Coming up, our interview with Joyce Chang, the chair of global research at JP Morgan. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
HSBC profit tumbles 80% in the fourth quarter after a $3 billion charge on its holdings in a Chinese bank. Chipmaker NVIDIA faces sky-high expectations when it reports later, as traders wait to see if one of the biggest stock rallies in history was actually justified. Plus, the UK delivers the largest budget surplus on record in January, a boost for the UK Chancellor ahead of the spring budget and general election later this year. Well, good morning, everyone. Welcome to The Pulse. Good afternoon if you're watching from Asia. I'm Francine Lacqua here in London. So from the AI boom to the rising geopolitical tensions across the globe and a record-breaking year for elections, JP Morgan has pinpointed its key strategic investment themes for the year ahead. Well, joining us now over the next 15 minutes is Joyce Chang, Chair of Global Research at JP Morgan. Joyce, it's so good to speak to you, especially when we're trying to understand the markets that, frankly, are not always easy to understand. Are these markets priced to perfection?
Well, I mean, it has been a record-breaking year for capital market activity to start the year. I mean, in credit markets, we saw an all-time record high, $361 billion of issuance in the month of January in the credit markets and the leveraged loan markets, record highs. Now, I think you stay fully invested here, but I'm not surprised that you're going to see, a little bit of a pullback here. And you have seen that the inflation numbers, surprised on the upside, which is sort of what we've been pointing to as well. But that was in the U.S. and Europe as well.
Why do you think these valuations are stretched? So was there an inner belief that started at the end of last year that actually central banks will act quite fast to cut rates, and so everything was priced in too quickly?
Well, I think there's the soft landing scenario, which we agree with for 2024, but 2025 could be a different story. But when we take a look at the central banks across the globe, I mean, we have by the end of the year, 80% of them are going to be easing. So that is a synchronized cycle. So I think the combination of recession off the table for this year, also the synchronized easing in emerging markets and developed market central bank. But your surprises have been, did too much get priced too quickly? And that's what we're seeing when we look at the inflation prints. And I think the market's going to turn away from looking at some of the earnings to focusing more on the inflation topic over the next few sessions.
So how are you expecting inflation to behave? A lot of the markets, of course, are pricing in cuts. That's now been delayed. But there's no clear view in my mind on whether inflation, on whether it's the last mile that's difficult to get to 2% inflation, or whether it's just going to be choppy.
I think that the 2% inflation target is not going to be met. The disinflation trend, though, I mean, what you're seeing is some stalling, but it's the services piece of it that's non-cyclical. That still the demand for services, for transportation, for sports, entertainment, wage pressures are still there. So I mean, we actually took up our inflation forecast at 3.3% for the first half of the year. We had it it at 3%. We always thought that the easing cycle would not start until June. So I think still by mid-year, though, you're going to have most of the developed market central banks easing, even with inflation still being above target. So I think it's bumpy from here, but everything got priced very quickly.
But this is because they worry about the labor market, or they worry that if they don't cut, the economy crashes?
Well, I think that there was a feeling that, particularly with the Fed, that they had done so many hikes that there's the room with the disinflation we've seen to do more of the cuts. I think it's actually trickier in Europe and for the UK, given where wage pressures are at. But labor markets remain very tight. So the market has, had been pricing in March cuts. That's been moved out. And the question is, will you see that there's some space to cut rates, but as you get towards the U.S. elections, that it's not nearly as much as what the market had been expecting at the beginning of the year.
Just when do you start looking in your research about what a Trump presidency means for domestic U.S.? At the moment, one of the things that I find most surprising is actually productivity in the U.S. going through the roof, and I can't figure out whether that's tech and AI or whether it's just finally things are kicking in.
So I don't think it's tech and AI. I think it's too early to say that. I think the surprise that we all got wrong was that immigration is back to pre-pandemic levels, and this is why the labor market has been so tight. So I think the labor productivity is very much related to immigration, and of course, if it is a Trump presidency, that whole question, comes up again. But the key policy things we're being asked about Trump right now relate to tariffs and whether this could mean the continuation of stronger U.S. dollars, and what this means for actually other foreign currencies, including the euro, CNY, Mex peso in particular.
And we've seen it also with the Biden administration. They've been pretty tough, actually, on China. So is dollar going to strengthen no matter what?
I think the dollar will remain strong. I don't know if it's going to necessarily strengthen further from here, but we've done some scenarios that if you take a look at a proposal for a 10% universal tariff, we think that is 4 to 5% appreciation of the dollar. So that does, have consequences. It's a growth penalty for the rest of the world and a stronger dollar.
There's so many questions about debt, and I know there was a lot of focus 2 weeks ago on some of the auctions. Do you worry about a credit event actually going wrong in the U.S.?
I don't really think that it's a credit event that will go wrong. I mean, there is hidden leverage that's building up, but it's building up in the private markets. So you're not going to see the type of forced deleveraging that we've seen before. And we've seen that the market conditions for both investment grade and for high yield coming to market, and the private market dry powder has given a lot of cushion here.
But the private market, I mean, there was worry about commercial real estate and, the spillovers, for example, in Europe and especially the UK.
Yes.
Is this a concern? Do we know where the bad stuff is? Or
well, I don't think it's a systemic concern.
Fine.
It is certainly a concern in certain pockets.
Yeah.
But for something that is systemic, I don't see that. And what we've actually seen is this increase in commercial bank lending that has come up as well. So I don't think it's a credit that will do this, but the credit market is priced for perfection. I mean, this is one where, just the pickup is very, very small, for what you're actually getting on historic basis. So I think it doesn't have the best value right now, but I don't see the accident really playing out there.
There's so much focus on NVIDIA. Does that really give you a bellwether on whether the current market valuations are okay? Are we expecting too much of one company?
Well, I mean, look, the bar is very high to beat what the expectations are because they're sky high. So I think the numbers are going to look good. You could still see the market go down, though, just given how much has already been priced in. But I don't see really stepping away from staying fully invested, particularly with the soft landing and the Fed easing still to come.
Do you move money around to, for example, Europe or the UK, where valuations have been pretty ropey?
Well, I mean, look, we still think that your risk in Europe and the UK are higher than the US when you look at growth downside surprises and where consumer sentiment is at, and that you still have this precautionary savings. You haven't gotten the consumer sentiment back. So I think the US is still to be preferred. I mean, another one I would throw in is that even though it's a 33-year high, Japan equities, we think over the longer term, even with the fourth quarter contracting, those numbers contracting, still holds promise over the medium term.
I mean, a number of challenges, I would say, for the governor in the next couple of months in what he does with this monetary policy.
Yes.
Will he get it right, or is it like if he gets it right, everything's fine? If he gets it wrong, than you get out of Japan?
I think that they're going to be very patient on how they exit. But more beyond just the exit, what I do see is that really animal spirits are apparent in Japan right now with respect to the asset reflation, the property prices, also just personal income trends. So I think they will be patient there. So I don't think it's about any one meeting, but they're not in a rush right now. And the fourth quarter growth numbers were a disappointment.
Joyce, what's your take on the UK? Again, the central bank probably has one of the hardest jobs because it's a tight labor market, it's a small, open economy.
Well, of all of our global forecasts, the one economy that we do have in recession second half of the year is the UK. So I do think it is a tough place, but we still have that you will see, some room to ease around the middle of the year. But I think the wage pressures are much higher. The housing affordability situation, mortgages are still a problem here, even as we're seeing a turnaround in some other parts of the world. So I think it is a very complicated situation here, but there's still some scope to ease. It's whether they're going to have to actually bring it forward a bit more, just given where the growth dynamics are at.
But so what you're saying is basically if they don't cut sooner, then they definitely go in recession, or do you predict a recession almost no matter what the Bank of England does?
We sort of had in our baseline, a modest recession, and other places where you might be skirting it. Yeah. But in the UK, that it looked more apparent. But I think the timing for what they do is very much dependent on how you see some of these labor market pressures playing out. We still see some scope to ease, but is it going to be more backloaded, or will they bring it forward just depending on how the growth numbers look?
Any value in gilts?
I still would say the U.S. exceptionalism, the dollar story, still is one that is dominant amongst the developed market currencies here. So, so we think that on the currencies that particularly as you get towards Super Tuesday, you get the nominations in place, and it looks clear that it's Biden-Trump, which is already pretty clear in my mind anyway, that you still have that stronger dollar trend really prevail here.
So interesting. Joyce, thank you so much. Don't go anywhere because we'll talk about China and Europe next. Joyce Chang, Chair of Global Research at JP Morgan, of course, stays with us, and this is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
The conversations that matter, the insights you need. This is A Pulse, and I'm Francie Lacqua here in London. Now, still with us, Joyce Chang, Chair of Global Research at JP Morgan. Joyce, thank you so much for sticking around. We're talking a little bit about some of the markets, and of course, the fact that you don't see a recession, certainly in the U.S., is a key risk to 2024. We touched on politics. Is it, when you look at interest rate cuts from central banks around the world, there was a belief maybe 6-7 weeks ago that the Fed would go first. It looks now that the ECB would go first. Does that change market dynamics?
Well, we never were in the camp that thought that the Fed would move in March. We thought that the market was getting way ahead of itself. Now I think you're actually looking at mid-year where it is going to be somewhat synchronized between the ECB, the Fed, and the Bank of England. Will they actually have to sort of move up their timing as well? So I think you are looking at synchronized cuts, which is one reason why there's so much reluctancy to cut holdings in this market when you can see that the easing is coming forth. But I still think what stands out is that the U.S. growth story is still one that looks to be in a much better place than the Europe or the U.K. And the questions that we have been getting on Europe have really been about, like, with the wage increases that have happened, why haven't we seen more of a recovery in consumption? Why is it still only a 0.5% growth that we're looking at in the EU this year, last year?
And how difficult is that to explain, actually? Why?
I think there's the proximity of the wars, that are just, much closer in. You also have elections on the parliament side where it seems like the center-right is going to pick up. But I don't know how much of it is just, there are questions about the longer-term model for Europe, the dependency on Russian gas, and, there's more trade with China that has actually increased, and just questions more about the model and the uncertainty from the geopolitical risks that are just playing out more here, whereas the U.S. seems to be one where it's more about U.S. exceptionalism. There's more of a story on innovation as well that you can talk about.
But Joyce, how would you play Europe? I mean, Germany is a huge concern for, of course, the Chancellor, but also the rest of Europe, because they have huge economic concerns.
Well, I'm talking to our strategists, a lot of them have been actually recommending Greece right now. I mean, within Europe, they think that, France is actually looking more promising right now. But, still a lot of questions about, the overall outlook for European growth, which still remains very anemic and tepid at best.
China, I have a lot of questions on China, which is probably the economy that's most difficult to read. Has Chinese real estate bottomed out?
I think that China still has a problem with the property sector as its Achilles heel. It does look to be a double dip this year, even with the measures that they're taking. And the problem is both a supply and a demand problem. So I think that the steps that the government is taking right now have provided some form of stabilization, but it hasn't provided the confidence boost. And so I actually see a lot of similarities when I look at Europe and China, that you just haven't been able to get the domestic private market and that confidence to come back very easily.
And Joyce, it hasn't also, the markets were expecting something a lot more from policymakers. So I don't know whether it changes the longer-term trajectory for world growth.
Well, look, if you take a look, we have to talk about the debt, because the U.S. and China have actually been growing their debt at the most rapid pace. But if you take a look at China, just last year alone, you had more than a 12 percentage point increase in their debt. So they can't do much more on the fiscal side. And some would look at the U.S. and say, well, look, that's the most predictable crisis you can see coming forward at some point in time. So I think you have to put the debt dynamics into this as well. So even if you avoid the inflation, you may not see that you get much relief on the rate side. That's really what's playing out right now.
I think that there was a belief that also the Chinese economy was significantly changing and going up the value chain. And it was my understanding that they need to go up the value chain by around 30% to actually, make the economy work. Is that happening?
Well, there are certain sectors that are doing very well, like the dominance on the electric vehicle side and some of the advanced technology. But if you look at the overall investment in China, you still have not seen the private investment has come back. And we are seeing movement of the supply chain. It used to be when we did some of these surveys, businesses would say, 10 or 15% of them were moving some part of the supply chain. Now that number's coming out 25 to 35%. So even though you see certain sectors where China is doing well, the overall numbers that are printing for private investment have been really disappointing. And foreign investment, the first outflows in 26 years.
So given that, how do you play China?
Well, right now, valuations are looking more compelling if you're a dedicated emerging markets investor. But I still think the story for a crossover investor to come into China, they haven't seen the reason to find that very compelling yet. So, dedicated investors have basically said, well, you look at valuations and you're taking more of a medium-term view, there are opportunities there. And I agree that on valuations, there's a tactical play. Yeah. But what we are seeing is just this 10-year trend of getting real money to come into China as a crossover investor. That's what's not going to come back very easily at all, in my opinion.
Joyce, you travel the world and speak to investors and speak to your clients. How many questions do you get about why markets are ignoring geopolitics? I mean, there's 2 wars, active wars. There's concern over Taiwan. The world feels so much less safe than it did 4 years ago.
Well, I think the first question that I end up getting when I'm overseas is about the U.S. elections. And then questions about the geopolitics from there, like what will happen as far as funding for Ukraine. If it is a Trump victory, what will happen in the Middle East? Will this become more of a regional conflict? But I think in the Middle East, the feeling is that, at least it's not going to hurt the oil exports that much. And you have all of this capacity that's in place right now on the energy side. I think there's also a view that on the commodity markets, like if you have the Fed starting to ease, that's going to be good for commodities. I mean, look at the soft landing in 1995. You had commodities up about 20%. And I think that there's this feeling that you have these conflicts in place that are not going to be resolved, but they won't necessarily escalate more from here. But all eyes are on the U.S. elections.
Joyce, I mean, I usually ask, is there any chance that actually world economies can Trump-proof their economies? And I usually get eye rolls, certainly from leaders. But is there? Are we moving into that direction?
Well, I think you are moving into more regional trade agreements.
Yeah.
A rise in industrial policy, which you can see in many parts of the developed markets and the emerging markets. So I don't know if it is so much just like putting in guardrails, but it definitely is looking at greater self-sufficiency and more flexible cooperation.
Yeah.
That you see with emerging markets countries, they don't want to have to choose. They want to be able to be flexible in how they choose their alliances.
Joyce, thank you. Smart and sophisticated thinking is what we always get from Joyce Chang, our the chair of global research at JP Morgan. Now, coming up, markets on tenterhooks ahead of NVIDIA earnings that will confirm whether sky-high valuations are justified or not. We'll have more on that story for you next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, NVIDIA is in focus as a chip maker at the heart of the AI boom reports earnings later today. Now, shares sank more than 4% yesterday in the run-up. So let's get more from Bloomberg's Alex Webb. Alex, thank you for joining us. I mean, it's really quite incredible, the expectations for NVIDIA. So is it almost a given that investors will be disappointed, or can they actually deliver?
Well, on one level, expectations are exceptionally high, right? The guidance was for revenue of 20 billion plus or minus 2%. The market's expecting 20.4 billion, which is literally 20 billion plus 2%. So anything below that is likely to be disappointing, but they have a track record of consistently beating expectations. But if you look at it through the valuation at which they're trading, they're in the sort of 35 times forward earnings multiple. That isn't actually way outside the realms of normality, right? It's actually maybe 5th or 6th in the SOX index, the Philadelphia Semiconductor Index. AMD, sort of smaller competitor in the AI space, is trading at a way higher multiple. It's partly, of course, because it isn't yet getting those earnings from AI that NVIDIA is. So, and of course, Microsoft, now the biggest company in the world, trades at about 33, 34 times earnings. So it's in that ballpark.
So you're telling me it's cheap?
I'm not saying it's cheap, but it isn't way up in the stratosphere in that particular sense. Of course, it's gone from being a $700 billion company to a $1.8 trillion company in just over a year. So, it's clearly enjoyed a huge expansion, but its revenue has also more than doubled in the space of a year. So, yes, expectations are high. We've seen some options trading, which is anticipating a move of as much as, I think, 11% in either direction, which is perhaps why you saw a bit of profit taking yesterday. That clearly is because, if it beats, then there's a big leap. And if it misses ever so slightly, then, of course, it's not going to be good news.
But if you look forward, so how long can this pace of revenue growth actually last? I mean, do you look at blueprints, or is this just a different company from anything else we've seen?
Honestly, I don't know. We can see what the analysts are expecting. Analysts are basically expecting it to continue much at the same pace, going to, from 59 billion in revenue for fiscal year, what they call fiscal year 2024. It actually ends at the end of January 2024, going to 96 billion, sort of in this calendar year. Analysts clearly think it's going to keep going. The biggest issue for them right now is actually not necessarily demand, it's supply. Can they get enough capacity at, for instance, TSMC to make the stuff? We are starting to see some competitors gain a little bit of pace. Of course, AMD, we mentioned, some of their customers, the likes of Microsoft, are building and developing their own chipsets in-house that might take little chunks out of them. But for the near term, it certainly looks as though there's plenty of demand for NVIDIA.
But Alex, how strange is it that actually the whole NASDAQ is almost on, if not borrowed time, but if NVIDIA goes well and that share price goes up, then it kind of drags everything with it?
Yeah,
is that a fair assessment?
It is in a sense. I think I wrote a newsletter for the tech team over the last earnings cycle where I said, actually, if you think about this Magnificent Seven, and a few wobbles from some of them, and it's bad news for the market as a whole, but actually this time we have seen a few wobbles. We saw a little wobble at Microsoft, a little wobble at Google. The others seem to have done okay. Is NVIDIA then the straw that breaks the camel's back? Maybe, who knows? But NVIDIA's particular importance, perhaps because of the mixed picture at the others, right? I think that's the level in which we have significance.
So interesting. Alex, thank you so much. We'll all be watching those NVIDIA earnings. Alex Webb there with the very latest. Let's also recap one of the top stories this morning. Shares in HSBC have plummeted after disappointing earnings. The bank has taken a $3 billion impairment charge relating to its investment in a Chinese bank. You can see HSBC down 7.5%. We'll have a full roundup of the top news. Of course, we're looking at NVIDIA. Up next, Bloomberg Brief. Danny Berger in London. Manus Cran. Actually, Danny and Manus, I think, are both in New York. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Big tech struggles ahead of NVIDIA's pivotal earnings report. Wall Street waits to see if the tech darling can meet the sky-high expectations.
Meanwhile, HSBC falls short as unexpected charges hit profit. CEO Noel Quinn tells Bloomberg he remains optimistic.
Our confidence
from the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
swing. And there is going to be, there is potential for a huge swing and huge volatility in this, because it is, quite literally, it's taken over the zeitgeist of everything. Even bond markets are perhaps, you know, stacking up a little bit in the larder in case NVIDIA really unseats us.
It's that feeling, is this Volmageddon
I haven't been this
2.0?
excited since Y2K. Google that.
Time to stock up on your tin cans and get ready for the end of the world, it sounds like. Joining us now is Monica Defend, head of Amundi Investment Institute. Monica, look, we got to ask you, I know your focus is macro, so tell me, is today, with NVIDIA earnings, is this a macro event for you?
Well, not really. It's really related
cold water
to
all over it.
Not really. I mean, it's we're waiting for the minutes for the Fed and the ECB as a macro event, just to pencil and get a clear picture of what the central banks are going to do. But what will be happening today with NVIDIA will likely trigger some, possibly some volatility. But all eyes will be on this first on the Magnificent Seven reporting.
Monica, good morning to you. I mean, there's many different ways we can look at this market and risk. I like the fact that you bring to our thought processes that the correlation between stocks and bonds could be re-emerging. You're the second guest in quick succession to make this point. Extrapolate that first. It looks as if Monica will return to us in just a moment. There you go. She's back with us by the power of the button. So, Monica, just to continue there, you just flashed off the screen. Talk me through this correlation again between bond to equity. You think it's resurrecting from the grave?
Well, we hope so, meaning that when inflation moves lower, it will be a progressive, non-linear process, but this is what we are expecting. And with central banks progressively normalizing the monetary policy, these are the conditions for the correlation between stocks and bonds to turn back negative and allowing eventually a proper asset allocation diversification where bonds will play as a performance engine back again.
Monica, you mentioned Fed minutes are today. Lest us forget in the NVIDIA storm that we're going to get that too. Paul Donovan from UBS writing in that the Fed chair lacks the communication skills of his predecessor. So minutes offered a more considered view of where policy should be heading. Do you take the same view that almost the minutes are more important than the communication from the chair himself?
Well, I think they are important because they give more detail, and probably it won't be only on the path of the rates cuts that, by the way, we expect to be displayed mid this year, but having some fresh ideas on the quantitative tightening, because this is what can give some impulse to the curve to steepen, would be interesting to read.
What do you think they could afford to do in quantitative tightening given the current backdrop? They want more confidence. They want more evidence of a slowing of the disinflation narrative. So what is it that could be tweaked within QT that could help the steepening?
Yeah, I think that the central bank have been using rates to manage inflation, while QT is more on the normalization of the balance sheet, and they are well aware that shrinking the balance sheet have an effect on the market volatility. In the past, when they've been shrinking the balance sheet 10%, the equity market corrected on the low end. So I think they will continue to maintain very clearly distinctly the two tools. Having this in mind, they still need to have some confirmation that the inflation is going lower.
Speaking of lower inflation, Monica, China, at the moment, we're going to be speaking to the Rio Tinto CEO very shortly, and a lot of the question revolves around the strength and the quality of the stimulus coming from China. Now, you write that China is entering a low inflation era. What does that mean for how you invest, and if you can invest in China?
You can invest in China, but you need to fine-tune the risk budget and the exposure. So long term, there is this goal of getting a more balanced and inclusive growth, which is positive. But in order to get there, they will run into some volatility, let's call it this way. What they did yesterday, which surprised us for the size of the cut, is just a patch, or if it's not, if it remains an isolated actions. To see more on the policy front, we need to see a prosecution, a sequencing of intervention on the policy side. But definitely, what happened yesterday was positive. Having this in mind, tactically speaking, we underweight China and remain constructive on emerging ex-China as an equity exposure. The call on inflation will, and again, here we are quite below consensus because we have 0.2, 0.5. The consensus is a 1 percentage point higher, will open up possibly opportunities in the fixed income space out of the Chinese asset class.
You said that you were surprised by the policy response yesterday. It was the biggest cut in rates to the real economy on record. What other significant policy responses do you expect from the PBOC this year?
Well, they can continue on the accommodation. So if this is not an isolated action, this can be a policy game changer for the economy. On the other side, we think that also the fiscal policy should do something, but it doesn't seem to be the case so far.
Monica, thank you very much for being with us this morning. That is Monica Defend of Amundi. A timely finishing comment on China as we pivot to Rio Tinto's underlying profit, which fell 12% last year. Weaker commodity prices, we know the story, rising costs. But the world's biggest iron ore miner still managed to pay investors a higher dividend. The CEO joins us now. It is Jakob Storholm. Jakob, thank you so much for joining Danny and I this morning. Good to have you with us. So we look at the numbers, the dividend is up, and you're continuing with the $10 billion CapEx program. What we want to know is, should you be more conservative at the moment, given the tough background in commodities and the uncertainty in China? Is this not a little bit too generous on both fronts?
Yeah, that's the question, of course. But let's just look at the past first of all. We had 20% return on capital employed last year. Over the last 5 years, we have had 28% return on capital employed. We have a very profitable business. Last year, we grew our business by 3% in copper equivalent volumes. So we are profitable growing. And I believe that we are facing an opportunity-rich world. The energy transition requires more materials of what we are producing, like aluminium, like copper, and even a bit more steel as well. So I don't think so. I think we have a controlled growth, and that's what our customer needs. That's what the world needs, and we can do it in a profitable way.
Right. Does still, though, a growth tilt, if you still have that, and if you're seeing growth opportunities, Jakob, does that not mean it's come at the expense of a dividend? Could you have pushed it a little bit higher then?
Now, may I remind you that we are one of the highest dividend payer with a dividend yield of 6%, 60% payout, and over the last 5 years, we have paid $50 billion of dividends. So I would say we are very rich in paying dividend. But we also, last year, we turned 150 years old. We are a very long-term company, and we want to be around for the next 150 years and be relevant as well, because we believe that we can create value. So the choice is, we want to pay dividend, but we also want to grab very profitable investment opportunities.
And we'll come to the M&A opportunities in just a moment, whether you're still on the road for lithium or copper. But what we do want to talk to you this morning is the market's marking you down. You're down by 2%. You expect to spend $1 billion on closure activities. Is that the upper level on what it's going to cost you to close down sites that you don't want? And could that hinder the dividend in a material way? So is $1 billion the top end of the closure numbers?
So yes, the reality is right now we are facing some of the world's largest closure, the closure of Gove, the aluminium business in northern Australia, the closure of our uranium business, EIA, and the closure of what was the world's largest diamond mine, Argyle. And that's the brunt part of the 1 billion. But you know, you have to just understand the mechanics here. We have already provided for this, so we have deducted it in our earnings years back, and it is a provision, and we're just going to spend the money now. Because when you open a mine, from the very day you open the mine, you have to start thinking about one day the mine life comes to an end, and you need to rehabilitate. It's just part of the cycle of mining.
Jakob, one debate Manus and I have every day with guests is the scale of disinflation we're seeing in the economy every day. What are you seeing or not seeing when it comes to things like labor, parts inflation, or on a broader scale?
Yeah. So I think a year ago, it was very complex, and there was a lot of bottlenecks. I think the Western world particular has, but not only the Western world, the Eastern world as well, I think the world has got its supply chain much, much better in shape, and calming that down has reduced inflation and has more enabled growth. So I think the world, from that perspective, is in a better place now, having COVID somewhat further away from now than a year ago.
Jakob, we look at images of the housing sector in China. We debate that on a daily basis, and we look at pretty brutal images of cities being flattened, demand being demolished. You're at the front end of delivery into that, aren't you? So how would you describe the gravity of the situation in China in terms of demand, real demand for iron ore, and the gravity of the economic situation?
So I cannot claim to be an expert in all aspects of the Chinese economy, but the Chinese economy that I and Rio Tinto are facing is the very physical part of the economy. And what we see is that the demand for steel is strong. We see the steel mills are running flat out. And why is that? Property has had, now it's probably the fourth year of adjusting, and there was contraction last year. But there's a lot going on in infrastructure. There's a lot going on in a number of industrial sectors, not least the automotive, with a near explosion in electrical vehicles. So net, the demand has actually grown last year. So we are facing a growing economy.
A growing economy in China. Jakob, what about the rest of the world? Stagnation nation in parts of Europe, an American economy that continues to be strong. How would you describe the global picture for demand?
Yeah, I think sometimes people are pessimistic because they say that it's a difficult world, and it is a difficult world. There are wars, there are geopolitical tensions, but it is a world that is growing. You're absolutely right. The US economy is growing well, the Chinese economy is growing well, and there's somewhat less growth in Europe.
So, Jakob, a year ago, there was this sort of very big moment, lots of commodity commentators, ex-Goldman Sachs people, etc., talking about a commodity super cycle. I'm interested to know, as you look at mine closures, you're concerned on certain fronts, is a commodity super cycle something that's in the rearview mirror? Are you still committed to that as the outlook? I know you're the CEO of a major mining company, so I know which road you're going to travel, but do you still believe that we're about to embark upon a commodity super cycle or something much more subdued?
Yeah, no, look, I actually said I was not going to predict a super cycle when that discussion happened a year ago. But I do think it's important to understand that the energy transition is happening. Addressing climate change is happening more than any place in China right now. So the build-up of solar and wind, increasing the grid, building EVs is a very physical transition, and it requires more aluminium, more copper, and more battery materials. That is a kind of a physical fact, and I think that is a train that has left the station. I think you will see that continuing over the next 10, 15, maybe 20 years.
But Jakob, we are in this moment where, especially when it comes to EVs, you can see the pressure in just EV car companies slashing their costs. There's a demand issue, there's a pricing issue, the headwinds are real. How does that change your demand mix for lithium, for those battery assets? Does that mean you also need to pull back?
So the reality is batteries, most batteries has a lot of lithium in them. and the need for batteries are only going up, not just for EVs. Stationary batteries are growing much faster than EVs. And I get that EV demand will go up a little bit and down from quarter to quarter, but there's been produced EVs at a completely different scale than a couple of years ago. So battery demand is absolutely going up, and it goes hand in hand with electrification.
So I think last year you relieved everybody when you said that you weren't going into the business of producing electric vehicles or the batteries for them. So well done. Now we know what you are focused on. But here's the issue, isn't it? It's where are the assets that you have the biggest desire to buy? Is it in lithium? Is it in copper? I mean, you're closing. I understand you're rebalancing the portfolio, but where are the pockets that you need to fill from an M&A perspective?
Yeah. So first of all, I don't need to fill anything from an M&A perspective. We are very lucky in Rio Tinto. We have a lot in the cupboard. We have a couple of really exciting projects. One of the best lithium resources is in Serbia. I'm trying to unlock that. One of the best copper resources is Resolution in Arizona in the US. We're trying to uncover that and develop that. And then we have got an amazing exploration team that has a lot of prospects, and we're finding a lot. So we can go the organic route from exploration. We have projects that are ready to go into execution. I don't want to rule out M&A, but it has to be at the right price. I'm not interested in buying something just to become bigger. I'm interested in, if I can see that we can add value and create value, then we will consider it.
Well, there's the growth tilt we started the conversation with. So well done making that a circular one. Jakob, we really appreciate your time this morning. That's the Rio Tinto CEO, Jakob Stausholm. Manus, of course, they weren't the only ones to report, the big miners to report earnings this season. We have a few others too.
Yeah, I mean, Glencore, Rio, and Billy's, all three are right now. It's interesting when you look at the Glencore numbers. I think what's interesting there, Danny, we're down 4.3%. One of the biggest losers on the street this morning. Trading. We know that Glencore is the big trading house, the beast of trading. $3.5 billion is what they made last year versus a record of 6.4 the year before. That is down 67%. That just shows you, well, what's going on the trading floor. Right. No disrespect to anybody. I know it's tough to trade commodities, but it just shows you the big swings that you can have in that house.
It's about volatility, and the commodity volatility just hasn't been there in a way that it was previously in the post-COVID era. Okay, we have more earnings to get through, Manus. Still ahead, it's HSBC. Falling today, we're going to get into the bank's results and hear from the CEO himself, Noel Quinn, here on Bloomberg Brief.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's Bloomberg Brief. I'm Menace Cranny alongside Danny Berger in New York. So there's plenty to feast on the Amazon front story-wise. Amazon set to replace Walgreens in the Dow Jones Industrial Average. And this, of course, I mean, she's been digging very deep on the data front. I mean, this is about a rebalancing, I suppose, of what is the Dow Jones. Didn't really have a great deal of tech in it, Danny.
No.
And now it's got Amazon. What more do you want?
I know, right? I mean, okay, I should be honest. This comes from S&P's Howard Silverblatt, so I didn't do the digging into the data he did, but I find this really interesting.
Go on.
Because now Amazon's going to be one of only 3 stocks in the Dow that does not pay a dividend. So you're going to get a slightly lower dividend yield if you own Dow tracking indices. The other 2, Boeing and Salesforce. There's a fun fact for you. But it also means the other ironic thing, of course, it's the Dow Industrial Average. I mean, it hasn't been that for some time. But it's replacing Walgreens, and it means consumer discretionary is also going to get a heavier weighting than industrial stocks now.
And then the Dow Jones Transport, you've got Uber replacing JetBlue. So we've covered the story on JetBlue and its tough times. Now then, of course, it comes to the owner of Amazon, which is Jeff Bezos. He's just wrapped up 9 days. Oh, if I could work for 9 days, and if I had 50 million Amazon shares, Danny and I might not be sat together. But $8.5 billion, no, it's the truth. $8.5 billion is what this gentleman has netted. But of course, it's not just the selling of the assets, it's about where were you domiciled when you liquidated the trade, and that has a huge tax implication. We're not singing the Will Smith song, Welcome to Miami, but it has an impact.
Yeah, I did have to teach Manus the lyrics because he thought it was something different. But yes, you are right. I mean, look, it's no secret why he's done that. So he was in Washington State. 2022, Washington State says, we're putting in a 7% capital gains tax. So Jeff Bezos says, cool, I'm going to Miami.
Yeah, and off he went, hundreds of millions of dollars in savings in tax. Speaking of which, I'm off to Miami. I'll leave you for a couple of days. It's not a holiday. Going to work. We're going to work. Actually, FII having a big gathering in Miami, which is the Saudi Arabian Sovereign Wealth Fund. So we'll see what the movers and shakers are going to say down there.
I thought you were going to say you were going to leave me for $8.5 billion, which I wouldn't blame you for. Definitely wouldn't.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Brief. I'm Menace Grenny in New York.
And I'm Danny Berger. Here's what you need to know.
It is big tech struggling ahead of NVIDIA's pivotal earnings day. Wall Street waits for the tech darling to meet its sky-high expectations.
Meanwhile, HSBC falls short as unexpected charges hit profit. CEO Noel Quinn tells Bloomberg he remains optimistic.
And the Fed's January meeting minutes are also due today, offering traders more clues about where policymakers stand on the rate cut timeline.
And we have some breaking news on China. They're trying to do more to get in order the stock market. They have banned net selling at the opening or the close of the Chinese equity market. So if you're an institution on a net level, you can't be reducing your equity position at either tail end or the head start of the trading day.
I mean, these are classic trades, which is market on open trades, market on closed trades, and it's where a huge volume goes through to get the trade off the books immediately before the trading day. So again, it's about more constriction in liquidity and in free markets.
And let me take you to the markets, because by the time of the China close, which was, an hour or so ago, we did indeed have a positive day, because this wasn't the first piece of news we heard from China about trying to restrict some of the short selling, some of the selling in this market. They banned quants, not banned, but they're doing more measures to stop quants and other leverage traders from participating in short selling this market. So you already saw a boost of about 1 1/3%. Okay, elsewhere in this market, Manis, there's only NVIDIA. I don't even know why I don't just have NVIDIA on a board here. That is the only thing it feels like matters. Of course, we're just talking to Monica Defend at Amundi, who said, Fed minutes, don't forget about those. We are nervous this morning. S&P futures down about 0.2%. NVIDIA's lower by about 1.4% this morning. European equities, they are down about 0.1%. You had HSBC earnings. Those disappointed. We'll get to those throughout the rest of the show. But again, Manis, in the words of Goldman Sachs, NVIDIA is the most important stock on this planet Earth.
We're certainly careering towards a market cap. If it keeps going on this trajectory at the speed and the pace, it could outpace the combined value of some of the other major tech stocks. Now, when it comes to the bond markets, we're down a tick. Let's see what those Fed minutes actually bring to us. Larry Summers has lit the torch of rate hikes. It's wonderful. It's now popped up as a 6% probability or possibility as a tail risk. But I do pay more attention when Kit Dukes at SocGen sends through his note, and he goes, the U.S. economy will remain strong, it will reaccelerate, and therefore the Fed may well have to hike, and therefore the dollar will go bid. Oil is down by 0.6%. What you've got there is, again, this narrative of higher for longer. We'll see whether that's pumped through in these Fed minutes, but that higher for longer narrative taking oil lower despite the geopolitical risks in the real market, in the crude market, the physical market. The time spreads are the strongest since October. So the real physical market is slightly tighter than what the futures are telling you. And the dollar is flat at the moment, 12.43, as we wait for those Fed minutes. Danny.
I found it really interesting in our conversation with the Rio Tinto CEO, because we asked him about China, because this is one of the big fears of the market. He said that it's growing in terms of construction. And Manus, that does sort of seem to tilt its hat to this idea that what China is doing in stimulus, trying to get the property market back up or the construction market back up, at least as Rio Tinto sees it, means that they can continue on their full growth trajectory.
And I think if you go back and you listen to that conversation, it's very much a CEO. He said, look, I'm not omniscient in regards to the entire Chinese economy, but what he can see is the real economy. And that sounded as if there was almost a floor being created in that housing market and in the economy. And that plays out then to the flow of money. The international investors that have exited China, that outflow of money, is that the low point? That's the debate that you need to have. And then the investability of China is key.
Right, exactly. And he did say Europe is slowing. America continues to be the winner above them all. But of course, America is going to get a test today in its stock market, Manus.
It is.
It's NVIDIA Day. It's the world's third most valuable tech company this year, as its market capitalization climbed by an insane $500 billion. That, just sit with that for a moment. $500 billion this year. It's now going to be put to the test as it reports its fourth quarter results after the bell. Let's get now to Mandeep Singh of Bloomberg Intelligence's and our very own Alex Webb to dig into this. Mandeep, I want to start with the options, because Manus and I have gone back and forth on the data here, because there's a crazy options built up. The most popular open interest by open interest option right now is $1,300, basically a doubling, a big old YOLO punt, a doubling of the price of NVIDIA. Options say it's going to move 10.6%. What does it mean to have this type of options build up for NVIDIA's earnings? How does this change the stakes of today?
I mean, look, what they've done in the last 3-4 quarters is a significant beat and raise. And that's why, you know, this kind of options move isn't really unprecedented. I mean, you see that with tech stocks all the time. I do think, you know, the focus will be on, you know, how they are thinking about expanding supply. What is the embedded pricing growth? Because remember, a lot of their growth has not come from shipping more units. It's come from demand and pricing. And that's hard to sustain. So really, the demand is there. The question is, can they get enough supply to fulfill that demand? And then going forward, what is the pricing growth embedded in their expectations?
Well, Alex, let's bring you into the conversation here. Danny and I also looking at the Goldman Sachs comment from Mr. Rubner. NVIDIA is the most important stock on the earth. And that's when you know you've got swag, global swag as a CEO. So there's a lot sitting on his shoulders. But when you look at the breakdown of the various components within NVIDIA, data center is by far the most powerful bulwark of this company. And it's going to be presumably about the growth trajectory of that business that's going to be critically important as well.
Yes, these chips are very much being used by cloud operators. If you think about the AI revolution, evolution, whatever you want to call it, it is very much a cloud product. The reason that Microsoft really needs that relationship with OpenAI is because OpenAI's products, GPT-4, at the forefront of it, of course, if you want to use that, the odds are you've got to be using Microsoft Azure to do it. So it's a really good way of getting people into your cloud. Same with Google, Gemini, that they are, if you want to be using those sort of systems, you likely have to be in Google Cloud. So that's why this is massive investment going into data centers. They need these chips from NVIDIA in the expectation that then the demand for the cloud AI services is going to boom in the months to come. I mean, to the Goldman Sachs point, the thing that's quite interesting about this all is, like, I suspect they wouldn't be making quite such a strong comment if the picture for the other tech companies hadn't been quite so mixed. You know, we've not seen a uniform set of earnings from them. We've seen this, you know, slight wobbles at Microsoft and Google, decent numbers at Meta. You know, it's that mixed picture that means actually, well, does that make NVIDIA sort of the decider in terms of, you know, how the market develops from here?
Or Alex, could it mean if NVIDIA has another blockbuster quarter that we literally start to forget about those laggards, that, you know, Tesla definitely getting kicked out of the Mag 7? I mean, does this change sort of investors' mind on the leadership of this equity market?
Well, you know, these sort of dynasties rise and fall, don't they? You know, not all that long ago, we were talking about FANG stocks, then we had Manga, like all these, you know. yes, it's distinctly possible that at a certain point we say there's a dislocation between NVIDIA and Microsoft and perhaps Amazon and Apple and then the others. At the moment, things look pretty good for NVIDIA, but there's just a little bit of clarity on that. You know, NVIDIA's trading at something like 35 times its forward earnings. That's not massively more than, say, Microsoft, which is at 33 times its earnings. It's actually trading at a discount to AMD, which is about 45 times its forward earnings. Now, of course, you know, AMD isn't growing as quickly as NVIDIA, so that's why perhaps the expectation, or the reality is yet to catch up with the expectations. AMD, therefore, perhaps under a little bit more pressure even than NVIDIA is, despite not having the gargantuan, you know, 1.8 trillion valuation that its rival does.
I think there's a nice context to put around it in terms of a dynasty, which is still technically, if you look at those on a valuation basis, in its infancy. Mandeep, talk to me about the adapting to export controls, and specifically around China. We saw a huge amount of discussion around the discount for Apple being in China, producing in China, exposed to China regulation from the government in terms of using Apple handsets. Here we are with NVIDIA. To what extent is NVIDIA restrained or facing restraint or export controls in regards to China, and how important is that market to NVIDIA?
I mean, it is. In the numbers, you can see it's a 20% revenue exposure. And the thing about NVIDIA's customer is it's concentrated across, you know, a few companies. As Alex was saying, it's the hyperscalers that are buying all these chips and deploying it on their clouds. It's the same thing in China. So if the government in China has control on what Alibaba, Tencent, and all these large companies, what they do in terms of building their infrastructure, that will have a bearing on, you know, how they are thinking about getting these chips. At the same time, I think NVIDIA has done a great job of changing the specs and really make sure that they are complying with the regulations, as well as shipping their chips in China so far. So clearly the execution is good, but it's a risk if they are completely barred out of that market.
Mandeep, one thing that I'm always caught about is Dan Ives, every time he writes about NVIDIA, he always calls Jensen the godfather of AI. He wrote in a note a couple days ago saying that when NVIDIA holds its conference call and Jensen speaks, you will be able to hear a pin drop on trading floors across Wall Street. What kind of figure has Jensen become, not just for NVIDIA, because that's obvious, but for AI as a whole?
I mean, look, that's the thing about a founder-led company, and he has been pioneering this, you know, from his gaming GPU days. And the data center business has come about in the last 6 to 7 years. I mean, we're talking about a $100 billion run rate business over the course of the next 2 years. So it's phenomenal what he has accomplished. And clearly, they are the trailblazers when it comes to this technology. The question is, their margins and growth are the envy of pretty much everyone in the tech and semiconductor community right now. And that's what attracts a lot of competition. I do think, you know, others will try to use custom ASICs and accelerators wherever possible. And that's the kind of the challenge they have, is in terms of sustaining this kind of growth at the levels where NVIDIA is right now, and given the competition they're attracting.
Okay, gentlemen, let's see how the numbers come down a little bit later on. Mandeep Singh for Bloomberg Intelligence, Alex Webb over at Bloomberg News. And coming up, another CEO from HSBC, Noel Quinn. The stock sinks this morning. The bank reported a surprise $3 billion charge. We get into the results and we hear from the CEO, Noel Quinn, on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranny alongside Danny Berger in New York. Well, the stock of HSBC is tanking this morning. Disappointing earnings. The bank took an unprecedented charge against holdings of their Chinese bank. The CEO, Noel Quinn, spoke about those charges a little bit earlier today on Bloomberg.
Well, I'm very pleased with the fact that we've been able to report 30 billion of PBT, which is obviously a record. But also, I'm very pleased with the return on tangible equity. We've been working hard for the past 4 years to make sure we deliver mid-teens returns, and we did that last year. Before material notable items, we had a return on tangible equity of 15.6%. I'm also really pleased with the dividends we've announced, 61 cents, which is the highest dividend for the full year since 2008. And we completed $7 billion of buyback, and we announced another $2 billion, up to $2 billion buyback this year. So I'm really pleased with that. Strong capital generation, and I believe with a CET1 ratio of 14.8%, we've got strong potential future capital distribution as well. In the fourth quarter, we did have some noise in the numbers. We had 3 principal items that pulled down the profit. The first one was we rebooked the loss on sale of our French operation now that we completed that transaction. It's neutral for the year because we took a credit on that in Q1 and we've taken a charge in Q4. So that nets each other out and neutral. There was an adjustment for hyperinflation in Argentina driven by the devaluation that took place. That's really a technical issue. And then the third issue, technical issue, was BOCOM. We have had an investment in BOCOM for 20 years. Every quarter we have to do a valuation in use test. We did that again this quarter, updated the model, and it compares the value in use to the carrying value, and the value in use dropped below, and that resulted in a 3 billion charge. I just want to make clear that has no impact on our capital position of any significance. It does not prohibit distribution because it's non-capital impactful. It is a technical accounting issue. And I also want to reiterate, we have strong confidence in the China economy. We believe there are huge opportunities ahead, and we believe that our partnership with BOCOM has been a good partnership for 20 years, and that status has not changed.
HSBC CEO Noel Quinn there speaking to us a little bit earlier on Bloomberg. Here to talk through the numbers is Tom Metcalf. Tom, the stock is down 7.75%. We're having one of those cathartic, convulsive moments, which is they've cleared the decks on BCom, they're taking a hit, but they're still paying out in terms of the dividend. Why such a brutal reaction when you hear Noel's justifications on why he's taken those actions?
Yeah, I mean, you look at
look at the share prices, you think, ouch, right? And I think the reaction more comes from just the surprise. You know, I think the difficulty here is in Q3, they were asked about BoCom. This is really what seems to be surprising people. And they said, look, we're comfortable with it, it's fine. So I think it's just that disconnect between what really happened, you know, so that the next quarter you suddenly do take this $3 billion hit. But I'd actually sympathise with what Noel Quinn was saying. I think this was a strong set of results underlying, very noisy. And yeah, look, as a former auditor, I can appreciate these sort of accounting terms, you know, are slightly disconnected from what they probably perceive as a pretty strong underlying business.
Tom, what did you make of his comments that we just heard there about him being optimistic about the Chinese economy? Again, at the same time, when he has to take an impairment related to China.
Yeah, exactly. Again, that's a slightly odd disconnect, but this is probably fundamental in terms of the timing. I think in the short term, very bumpy. You know, these sort of surprise hits are not helpful to sort of investor sentiment. What HSBC's story is look, in the medium term, there is no other tale here other than that China will continue to grow, continue to be, you know, key cog of the world economy. And if you believe that, you know, which obviously requires a deal of faith right now, then it does look like a good story for HSBC because of their positioning. But right now, the trouble is they're exposed to China. It's going through a difficult moment, so you get these surprise hits, and it's not quite the engine of growth it previously was.
Well, let's talk about the bonus pool. It's hit a decade high. That's almost, also seeing Quinn's pay almost double. Are they going for breadth, or are they going for rainmaker retention? Have we decided which is the avenue, which is the road for travel for Quinn and HSBC?
Well, yeah, look, definitely right at the top, they've sent a message, right? Quinn's pay has doubled. And, you know, it kind of does look a little bit unusual when you see the hit profit took this quarter. But again, it kind of speaks to, like, you know, if you get away from the noise today and look at overall their performance in 2023, you can kind of understand why the board feel, you know, the HSBC machine is moving forward in the direction. And in terms of all the other bonuses, again, that's reflected. It's kind of a bit of a have and have not this season, right? We've had some banks really cutting bonuses, but some like HSBC push them up. And I think, you know, that's a broad-based lift and really speaks to what they see as a strong underlying business.
If you look at the pay of Noel Quinn himself, I mean, a near doubling in pay. You compare that to other CEOs. Barclays, their CEO, Venkat, was paid less. And we got the news yesterday that at Citi, Jane Fraser also got a big pay bump, about 6%. When you're looking at these different CEOs and the dissection of what they're being paid, what sort of message are you getting from the HSBC and Citi versus Barclays of the world?
Well, I think the big sort of differentiator here is if you head up a US bank, you are obviously making bank. It's, I think Fraser's total pay now is north of 25 million, you know, and that's probably on the lower end of the big banks in the US. And, you know, Quinn's pay has just doubled, but to about $15 million, I think it is. So there is still that massive difference between, you know, what you can get paid in the US. But yeah, I mean, and this speaks to this broader argument or discussion we're having here in the City of London, where, you know, the stock exchange is basically saying we are not paying our top executives enough because they can get much better pay packets in the US or in Asia. So it's definitely a live discussion. But obviously, you know, when you see someone's, you know, if you're at HSBC and your pay is risen by single digits, you look up at the CEO who's doubled, you know, you're probably going to feel a bit unhappy about that, I suspect.
Yeah, fair enough. I mean, who among us wouldn't want our pay to double?
Come to America.
Yeah, exactly. The land of the free, the home of the well-paid. Tom, thank you very much. That's Bloomberg's Tom Metcalf. All right, let's get a quick check on our markets this morning. S&P futures, they are lower because it's the most important stock in the world. It's NVIDIA reporting earnings today. But man, maybe bonds are back. They are bid this morning. Yields down by about 2 bips for your 10-year yield. But again, Monica Defend telling us the negative correlation, it is back in store. Bonds, they can play defense this time around.
Yeah, I mean, there are some other stocks out there. Palo Alto also have it.
There are other stocks. I literally had no idea.
How dare I?
Crazy.
How dare I talk about other stocks that? Well, that's the whole point.
No,
you know, Palo Alto's down 20% this morning. You are looking at a little bit of pain elsewhere in tech as well.
That's true, but I bet if NVIDIA had a big beat, I bet everything would follow it.
Everything will be perfect. Coming up, it's perfect on Bloomberg Week every single day.
No mistakes.
No mistakes ever. Big shout out to Maureen. Great show today. There you go. It's coming up to dawn in New York, 5:51 a.m. The sun will rise and stocks are just a nip lower. Down in Nathan 1%, 49.83. Good morning from New York.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
It's Bloomberg Brief with Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead. The Fed speak continues. We're going to get Atlanta Fed President Raphael Bostic speaking at 8 a.m. Eastern. Then 2 p.m. Eastern, the Fed releases the minutes from its January meeting. And then after the bell, it's the big event. NVIDIA will report earnings, coming with high expectations amid the AI trend. But Manus, am I to understand that there are other stocks out there besides NVIDIA? That sounds like crazy talk to me.
You know, I accuse some of the analysts of committing heresy on this show. I'm about to commit it myself. There you go. You've got Palo Alto coming down by 22.7%. This is a cybersecurity company. Network, it plunges. They cut their revenue forecast. So that just gives you a sense of what a wounded beast can look like when you underdeliver. The data centers are going to be front and center when it comes to NVIDIA. Also the margins, we've just had that conversation, down 1.4%. Of course, it has put on $500 million so far this year. So that just gives you a sense of the ramp higher there. Ford comes in unchanged. They are slashing their electric Mustang after sales plunge. I didn't buy a Mustang.
Well, now you can if it's cheaper. So there you go. Maybe that was good
living in New York. It's a bit like when they sold me a Cherokee Jeep in London. You don't need one.
No, I mean, you would literally take up the entire road. So that, yeah, that's true. That makes literally zero sense. Now for NVIDIA, we've talked a lot about the options, and I think this makes complete sense that people would be punting on these YOLO options, because if you feel like you've missed out on the rally, why not just buy options instead? So we have this huge buildup ahead today.
Yep, and it could potentially swing by about 10% on some of those options. Keep an eye on miners. They're also swinging around as well, but it is NVIDIA day.
Huzzah.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
We need the Fed to start cutting. We think that starts in June.
I thought we'd have 3 cuts this year. I'm probably going to dial back on that.
I think that they are sticking to their slower to lower interest rate mantra.
They're pretty going to pull the trigger in March. So by
from the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurize the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision, that's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Done, and how does this really transpire in a world where bigger is better when it comes to economies of scale and just general economics?
Well, this is a good question this morning, because after she tweeted about Capital One Discover, Senator Warren also tweeted about Kroger, and the quote was, "This merger should be stopped." And Bloomberg is reporting that the FTC and a group of states are poised to sue as soon as next week to block that merger. So if you're Capital One and Discover, and you're looking at what the FTC is doing right now with Kroger, do you think you have a chance to get this deal through in 2024?
The Democrat from Massachusetts loves to kick capitalism in the teeth and has done over much of the last decade. Speaking of kicking capitalism in the teeth, can we turn to China? The latest news out of China, our reporting right here. China has banned major institutional investors from selling more shares than they buy during the first 30 minutes of trading and the last 30 minutes of trading. And Lisa, they've also created a task force, according to our reporting, with the nation's stock exchanges to monitor short selling and issue warnings to firms that profit from those wagers.
Well, okay, and this comes after one of their biggest quant funds was banned for trading for 3 days after dumping a whole host of shares within minutes yesterday or a couple days ago. To me, this sort of raises this question, what's their goal? I mean, is this going to be opening up their market to new people? Is this basically the way that they're going to manage the underperformance of their stock market?
We started yesterday by talking about addressing the causes of the weakness. We talked about interest rate cuts, probably not going to work. Are they going to do something on the fiscal side of things? They're going to ban selling again. They're going to ban selling. That's the approach.
It feels like putting a Band-Aid over an amputation, which is part of the problem.
Yeah, I think that's a great one.
And I think right now it really raises this question of how much does it give people confidence to go back into a market that is heavily manipulated and heavily controlled? It creates a real problem.
Or maybe if you can't sell it, will create a lot of confidence because there is only one way this can go, Bramo, and that's higher.
Okay, you know, it's theoretically, yes. On the other hand, if you don't get that enthusiasm, who's going to be pouring money in if at any given time you're basically going to be hooked off the stage and being told, you know, forget it, you're not good enough?
I'm not sure how many international investors want to dabble in what's going on over there currently. Let's turn to the broader market. Equity futures on the S&P 500, negative by 0.2%. In the bond market, yields coming in a couple of basis points, 425.77. The euro not doing much, still in and around 108 on their currency pair. Coming up on this program, John Stolfus of Oppenheimer Asset Management ahead of NVIDIA earnings, Greg Valliere of AGF Investments as Nikki Haley vows to stay in the race regardless of South Carolina's results this weekend, and Claudia Sahm a little bit later this hour, the former Fed economist, on why she thinks the Fed should already be cutting interest rates. We begin with our top story. NVIDIA set to report after the closing bell. Today's earnings and forecasts looking to justify a market cap running beyond $1.7 trillion. John Stolfus of Oppenheimer expecting the market rally to continue to expand beyond the Magnificent Seven, writing this. In the S&P 500, 8 sectors are posting positive returns. In our view, this shows a continuation of a broadening in the rally that began at the end of October last year. Established tech companies are likely to prove to be key holdings. John, I'm pleased to say, joins us right now. John, let's get into that broadening out. What is it that you see that's driven some of that you think will prove to be durable through the year ahead?
Well, John, great to be on the show. Thanks for having me. I would have to say, one thing is I think investors are getting the idea that there's other values within the market other than technology, and a lot of it has to do with sectors that can be served by technology to become more efficient. In addition to that, as we've mentioned before in our conversations, we do believe that a lot of people are getting the idea that indeed Social Security becomes less of something to rely on as a core in one's retirement, and the need for investments that point to equities in terms of retirement portfolios. So we think the market has good support here. We think the Federal Reserve is doing a good job, and the lumpiness and inflation is just part and parcel of going through what we're going through, a normalization of interest rates.
John, you pointed to a structural reason to buy equities. Can we talk about some of the cyclical issues in front of us at the moment? You like cyclicals over defense. You seem to like energy. John, what's behind that?
Well, the reason why we like energy is the bridge between a point where the scale in the infrastructure for alternative energy will be achieved for it to become the major part of energy is years and years away, and the bridge that needs to take us there is traditional fossil fuel energy. And I think I'm certainly not one of the few people to think that. It's a general thought is that before we go all green, there's definitely a mix between black gold and greening that needs to be to get us there.
Is the broadening?
So we'd also say, by the way, oil companies have been known to distribute energy successfully for the last 130 some years. They should probably be given an opportunity to be at the core of the new energy program.
John, is the optimism about some sort of broadening out at the expense of the leaders so far, namely big tech?
I don't think so. I just think what it is, it's not that I don't think technology remains part of the leadership. Just the size of the sector would tell us that, it's important that it keeps running. But it just happens to be, we thought for quite a while now that technology today, very different from where it was during the tech bubble, really reflects the fact that technology is likely, when we look back on it from a historical perspective, likely in a position parallel to where the automobile was in the early 20th century, after Henry Ford had mechanized the assembly plant, brought up the quality and reduced the cost. The accessibility to the automobile, and it goes similar with technology for both all sizes of business and the consumers. This makes for a much more efficient society, and we're all on the upgrade cycle, whether we admit it or not.
John, I have to say, you used to be the biggest bull on the street. You're not anymore. You're not even close. There are people who are absolutely outpacing you, including Jonathan Golub and Patrick Palfrey at UBS yesterday, who now are talking 5,400. Based on your optimism, the fact that there's almost no gains on the S&P to get to your price target by the end of the year, does that give you pause?
It most certainly, when I see a lot of, and I'm not saying that the last few names, I don't recall exactly where they were, but there's been a bear capitulation last year and this year at an extraordinary rate. It always concerns us when everybody comes to our side of the boat. The only thing is that it does look from a perspective of fundamentals. If you just look at the earnings, Q4 earnings, and you look back at Q3 earnings, it just shows that earnings are rising, more earnings are rising. You have double-digit earnings growth in cyclical and technology sectors. I think this particular earnings season, utilities joined cyclicals and technology for double-digit earnings growth. That's curious thus far, based on what I'm seeing on my Bloomberg EA page. But we just have to say, Fed's doing the job. The consumer is remaining resilient. Jobs postings resilience, and corporate earnings showing resilience. We're not looking for robust here. And that tells us that maybe this positive attitude that we're beginning to see among the sea of strategists that exist might not be a bad call, though we'll keep the party hats in the box for now. We're not going to be dancing and celebrating.
John,
it's early in the year.
Just to be clear, does that mean that you are going to upgrade, or that you're basically happy where you are with respect to the forecast?
At least our discipline is that we will not change our target until our target is exceeded or our target becomes impractical in terms of where the market would have to go to attain it. So we're waiting for the market to take us to a close over 5,200, at 5,200 or over, and then we'll address it.
John, you talk about, instead of deglobalization, it's reglobalization. It makes me feel like when the U.S. administration talks about the fact that they're, not bifurcating with China, or, they're just trying to find other ways to shore up the supply chain. But when you want a reglobalization trade, what are you looking at?
Reglobalization really just means a diversification away from one country centric global supply chain. And I think that began probably about 2016, slowed some when China basically just ate the tariffs, I think. And then later on in the process of coming out of the pandemic, it became pretty obvious that one country-centric supply chain wasn't working very well. And companies now are diversifying their sources on a global basis. And we think that's good for Latin America. If we can get peace in Eastern Europe, it'll be good. And both, it should be good for both and emerging markets in Asia that are friendly to the U.S. We can't help but think that it benefits emerging markets, India included, and Mexico, Brazil, just for a few. This is a reglobalization for the simple reason, if you look at our trade deficit has just stays pretty bad. Since 1992, it's deteriorated. It just shows that both U.S. businesses and the consumer like to buy foreign goods because it's the competitively priced play. People like a good deal.
Hey, John, it's great to hear from you. Lisa says, come back when you've upgraded stocks. John, Thank you. John Stolfus of Oppenheimer Asset Management on the latest. No longer the big bull on the street. That's Jonathan Golub and Patrick Palfrey over at UBS. Here's the quote from them. Lisa, I think this is really interesting. While the market sold off on more robust CPI and PPI reports last week, our work indicates these demand-driven readings are constructive for future returns. So pushing out rate cut calls, and the reasons for that. We were talking about it. Is it good? Is it bad? We would argue it was bad if it's about hotter inflation reads. Jonathan Golub saying it's good for stocks.
Basically saying that it's the demand side of the story and the fact that people are going to keep on buying, which really plays to what Goldman Sachs was saying as well. Basically, this is going to be an earnings-driven rally that is going to be on the heels of strength that allows the Fed to keep rates where they are. I will just say, it's notable that Golub and Palfrey lifted their forecast on January 16th to 51.50. The original call of 48.50 was on December 11th. This is moving so quickly. It really is sort of surprising.
They've done it twice, a couple of days after Goldman also have done it twice. I think they started in October, November time as well.
Exactly. So
just ridiculous.
Yeah, moving faster than people can really
chasing this rally, I think it's fair to say that's what this is. Equity futures on the S&P 500 right now, negative by about 0.25%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. plans to unveil sanctions against Russia on Friday following the death of opposition leader Alexei Navalny. President Biden blames Putin for the death of Navalny, who had been imprisoned in the Arctic. The White House says the sanctions include a substantial package of financial penalties that target Russia's defense and revenue sources. HSBC shares are falling. Fourth quarter profit plunged 80%. The bank also took a $3 billion impairment on its holding of China's Bank of Communications. CEO Noel Quinn also announced a $2 billion share buyback. HSBC, while it was supported by higher global rates, it is still facing headwinds from one of its key markets, and that's China. A tie-up between two supermarket giants could be in trouble. Sources tell Bloomberg that the FTC and a group of states will sue to block the combination of Kroger and Albertson. The suit is expected before Feb 28th, and that's when an agreement not to close the deal expires between the FTC and the companies. Both Kroger and Albertson are prepping to meet with the FTC Chair Lina Khan to persuade the agency not to sue. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, Nikki Haley vowing to stick around and stay in the race.
I refuse to quit. South Carolina will vote on Saturday. But on Sunday, I'll still be running for president. I'm not going anywhere.
She's not going anywhere. That conversation is coming up next, live from New York City this morning. Good morning.
Was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Equity futures on the S&P 500 negative here by around about 0.2%. Yields coming down about a basis point. The 10-year 426.16. Under surveillance this morning, Nikki Haley vowing to stick around and stay in the race.
Many of the same politicians who now publicly embrace Trump privately dread him. They know what a disaster he's been and will continue to be for our party. They're just too afraid to say it out loud. That's why I refuse to quit. South Carolina will vote on Saturday, but on Sunday, I'll still be running for president. I'm not going anywhere.
Here's the latest this morning. Nikki Haley trailing the former president by an average of around 30 points, according to the latest polls. Haley struggling to get a boost from voters in her home state of South Carolina ahead of the primary this weekend. Greg Valliere of AGF Investments writing that despite Trump's dominance in the primaries, he does face challenges going into the general, writing this. His comments on NATO and his refusal to support Ukraine and Russian dissidents have concerned moderates, who were the key to his re-election prospects. Greg Valliere, I'm pleased to say, joins us now. Greg, before we get to Trump, let's talk about Nikki Haley. What is the strategy for her now?
Well, I guess she will stay in, John. I think it's not going to go very far. She, I think, will maybe stay in until Memorial Day, but I can't see a scenario where she can win the nomination. The intriguing thing is this group called No Labels, which would love her. They lost their two leading candidates, Larry Hogan and Joe Manchin, so they would love to have her on the ticket. I'm not sure she would want to do it, but if she says she's not going anywhere, that's the only place I could see her going.
Greg, Lisa asked that question, and she certainly didn't want to talk about it when we spoke to her in the last week or so. Greg, talk to me about financing. Does she have the funds to stay in this race for as long as she possibly can?
She has money. She's a great debater, one of the best debaters in all of politics, and she's fairly moderate, although she's changed her tune. 4 or 5 months ago, she was not this moderate, but she does have attributes, including money.
When it comes to money, what does it look like for the Trump camp? Because he's using a lot of these campaign donations to pay his legal fees, and it looks like he's facing a huge crunch on the cash front come this summer. Does the RNC step in and start helping him on his legal fees, or are they going to focus on campaign finance?
Well, since the RNC will be basically a wholly owned subsidiary of Donald Trump, I'm sure he can get some money from them. I think the big story on money is Joe Biden. He's out in California today raising more. He's raised a ton of money. That's not going to be a problem for him.
Does that shock you, given the fact that the whispers in the Democratic Party is that they don't think he should be the candidate?
But I do think, though, they believe he will not drop out and he will run. And if he is going to run, he needs a lot of money, and he's getting it by the bushelful.
Can we want to ask you also about what's going on in terms of mega mergers and how Capitol Hill is going to respond? We know Senator Warren has come out and said the Capital One Discover deal should not go through. We know the FTC, according to our reporting, is prepared to block the Kroger deal. How do you see the mood music coming out of Washington in terms of deals going through this year before the election?
It's clearly become negative. I think if these mergers are approved, it's going to take a long time. I'm not sure they can get done in time for the November election.
Is this one of the biggest places where there actually is daylight between who may be president? In other words, the policy is dramatically different if Biden is in the White House versus Trump.
Oh, yeah, there are big differences. That's one. I think another one is Jerome Powell. I think Trump would try to dismiss him within days of his inauguration. So there are a lot of big differences. One of the most intriguing ones is defense. We're going to see in Biden someone who would spend more on defense than a Republican, Donald Trump.
I'm struck by just this question of going back to Nikki Haley and why she's staying in. When you're talking about Donald Trump, there's sort of a full circle here. Is there a feeling that one or both of these candidates are going to drop out, with Trump being forced to with some of the legal pressures, and she's staying in long enough to pick up where he leaves off?
I think you've hit on it. Her strategy is clearly to see if Trump stumbles. If he gets convicted in a trial, if he makes more gaffes like he did about NATO, that's why I think she's staying in. She's staying in hoping he trips up, and he might.
Greg, do you really think that a future Trump administration may cut defense spending?
Well, the word cut, let's say that it would level off. I think defense spending increases would clearly slow down. The Republican Party, as you know, has become more isolationist, and I think that means the glory days the fat days for the defense industry are over for now.
Greg, how popular is that stance in this country at the moment?
Well, I think it is popular in much of the country. You see in the Midwest, for example, or among young Republicans, they're isolationists. They don't want to support Ukraine. They don't want to spend a lot of money on defense. Although I think the mood on Ukraine has changed significantly in the last 48 hours, I think Ukraine will get something.
I've got to say, Greg, I was struck by J.D. Vance's editorial in the Financial Times, a notably European-leaning publication, where he basically said the United States has provided a blanket of security to Europe for too long. He talked about how essentially the U.S. funding of their own defense that supports other nations is basically a tax on the U.S. that benefits the rest of the world. Do you expect this to be a popular stance going forward, understanding that J.D. Vance is maybe more on the fringes than, say, a Mitch McConnell? Is this becoming mainstream?
Yeah, and you have a divided party. It's Vance and many other young Republicans who just don't want to do what Mitch McConnell has wanted to do on defense. So that's a big shift. I do think that Mitch McConnell and Joe Biden will get something.
Greg Valliere. Greg, we've got to leave it there. Greg, it's good to hear from you, as always. Greg Valliere there of AGF Investments. You're all familiar with the meme, aren't you? The meme that has the Navy destroyers, the aircraft carriers in the picture, and then the text says something like, you're about to find out why Americans don't have healthcare. That's real. We've been talking about this for a long time. For the people outside of America that love to criticize how poor the infrastructure is, the lack of socialized healthcare, the Europeans that can sit on those towers, those ivory towers, and look down their nose about what happens in the United States on those issues. I think the J.D. Vance point in the Financial Times is a pretty important piece, very easy to dismiss, but when you really think about the bigger issues at play here, for a long time, the Europeans have been able to get away without spending much on defense. And watching bill after bill, monster bills, go through Congress, spending huge sums of money on American defense, which the American taxpayer, to some extent, big deficit, get it, to some extent, has to finance. That's an issue, and it's an issue they're taking on.
This line from him, as the American defense budget nears $1 trillion per year, we ought to view the money Europe isn't spending on defense for what it really is, an implied tax on the American people to allow for the security of Europe. That said, is this the appropriate time to be hammering on this point when Ukraine is on the brink of potentially suffering for some pretty massive losses? It's sort of a question of what do you do with that argument, given the fact that a lot of Europeans are waking up to this and are actually acknowledging it and saying they need to invest as well.
Also, Pew recently came out with some new research, and a majority of Americans think that it is important for the U.S. to continue to support Ukraine. So to Greg's point, at some point, I do think Senator McConnell and Biden will get it done, but is it the last package Ukraine will see?
That's the big debate right now. Coming up on this program, up next, the best performing stock on the S&P 500, reporting earnings after the close.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Live from New York City following a couple of days of losses. Equities down again by 0.25% on the S&P 500, down on the Nasdaq by 0.5%. Today is not about the Fed speak, the Fed minutes, the economic data this week. It's none of that. It's all about the earnings from one stock, Nvidia, after the close. If you switch at the board in the bond market, 2-year, 10-year, 30-year, looking a little something like this, down a basis point, 426.35 on a 2-year, down 2 basis points to 459.34. Those Fed minutes, Lisa, we can talk about them for a heartbeat, a couple of seconds if you want. I want to understand just how together this committee actually is, given the struggles that Chairman Powell appeared to have in the news conference, reflecting some kind of consensus on the committee.
Do they offer more guidance on what kind of thresholds have to be met for them to cut rates? And is that maybe where some of the disagreements are in play? Because we didn't really get a lot of color on that. A lot of people, note after note, in very elegant way, it went one way after another, said that nothing's going to happen. These are going to be really boring minutes. And basically, people are saying, don't just, this is sort of on the back foot right now with respect to all the Fed speak and with respect to the Fed minutes.
I think you've got to think about what's changed in between the meeting and these minutes as well. Hot payrolls report, hotter than expected CPI, hotter than expected PPI. The ISMs we've seen have been pretty decent as well.
Yeah, although some people are saying this might even open the door to another rate hike. And there have been a number of people.
You say some. I mean, are we just talking about one man?
We're talking about someone whose name rhymes with Wary Wummers, but I'm curious about whether we go forward with this sense of people trying to push back on that idea. Ian Lingen basically saying we're wary of the conversations about putting another rate hike on the table this far into the cycle. Other people basically being a little bit more aggressive. That's sort of where the nature of the conversation is.
It's a nice conversation point for now. It's a good way of getting yourself in stories and making headlines, I guess. Let's turn to foreign exchange. The euro looks like this. I mean, that can change. I'm not saying it's not going to change. I'm just saying for now it doesn't make a ton of sense.
Try to get into stories.
The euro, 107.98. We're negative here by 0.1%. David Folkers-Lando, Deutsche Bank, had this to say. Could we have the Fed battling with sticky inflation this year, just as Europe and China are seeking to combat more disinflationary forces? That would have currency implications, and our FX strategists remain bullish on the dollar versus the euro. That would make an interesting year.
Especially because that's kind of what's playing out. I mean, on one hand, you are seeing stickier inflation in Europe and elsewhere just because of some of the same dynamics post-pandemic. But if that shifts, what does that do to the U.S. that has been an echelon of isolationism, regardless of who's in the White House, with respect to the U.S. consumer?
The euro, 107.97, that currency pair negative by 0.1%. Under surveillance this morning, our top stories, chip maker and AI giant Nvidia reporting fourth quarter results after the closing bout today. Investors will decide whether the company's earnings and forecasts justify a gain of 40% year to date and a market cap to rival Amazon. Options are pricing in a swing of nearly $200 billion, which is a few percentage points for Nvidia. In value, pending today's results a little bit later, just the numbers, Lisa, they're astronomical. And every single time we set the bar high for them, they've beaten by double digits. they've raised again. And I think expectations today, what is truly a beat for NVIDIA? Is it a double-digit beat and a raise?
That's the reason why I think we saw a little bit of softness yesterday, the sense that maybe the bar is so high and we don't even know how high it is that it can't be good. And there's this expectation that usually the stock swings by 10% in one direction or another, usually up, after its earnings. So if you're trying to get ahead of that, you basically reduce your position and try to take some chips off the table, or whatever cliche you want to use. But this is, to me, yeah, okay, thanks, that's great.
It's good, it worked. It was a nice pun.
Thanks, I appreciate
Enjoyed that.
Okay,
Stock is down by 1.76% in the free market. Mandeep Singh, Bloomberg Intelligence, who'll join us on that name with more puns in just a moment. I want to turn to this story just quickly. President Joe Biden is set to unveil major sanctions against Russia after the death of opposition leader Alexei Navalny. The White House is not releasing any more details until Friday, but in commodities, aluminium and nickel surged on the news. Traders have been on the lookout for new curbs on Russian metals after they escaped earlier sanctions. Saturday, of course, will mark 2 years since Russia's invasion of Ukraine, largely spared, Anne-Marie. You wonder if they're going to be this Friday.
Well, the UK hinted towards this in December when they were barring individuals from trading some of these commodities, and they said, we will look for international partners to take a coordinated action. So this is something that's still left on the table. But you have to think, is this administration going to go so far that the repercussions are going to hit their own economies? Because what we've seen when it comes to oil and gas, which is how Putin continues to keep his economy functioning, how he continues to fund this war, is that they're willing to let them trade it with a caveat of a price cap.
In other words, it hasn't worked, right? I mean, essentially, pretty much everyone has said that the sanctions have not worked. It has not discouraged Russia. It has not reduced the amount of money that they've really brought in that materially. So this raises a question. Is this basically a messaging effort to basically say we're taking a hard line, and then to basically come out and signal we're going to do something harsh